Welcome to the CFTC's End User Roundtable, and thank you all for joining us today, particularly to our roundtable participants. Thank you for agreeing to come and discuss these important issues with us. I'm here today to lead the roundtable on Regulation 1.35, but we're also going to have a roundtable on volumetric optionality and the special entity de minimis for swap dealing. Our Chairman, Mark Weegan, wanted to say a few words before we start.
Thanks, Katie. Thanks, everyone, for being here. We have a good agenda, and it looks like a good list of participants and witnesses to help us talk through some of these issues. And so we really appreciate everyone being here and your contributions to the process of continuing to work through some of these lingering end-user issues that have developed from some of our rulemakings over the last several years. So thanks again for that. I wanted to just make one other announcement, which is that this morning I put into circulation a rulemaking that will follow up on the no action letter we released a couple of weeks ago on the special entity de minimis threshold. And in substance, it's by and large the same as the no action letter. But we thought it was appropriate to follow up that action with an actual rule proposal. So that is in circulation as of this morning, and hopefully we can get that out for public comment relatively soon. And so obviously there will be a session later on that particular issue, and so we're eager to hear what the participants have to say. And of course anything said here should be, or could be anyway, followed up with a public comment letter filed in response to the proposal. So I wanted to make that announcement and let everyone know that that's coming hopefully very, very soon. And in the meantime, we look forward to today's roundtable and talking through both the special entity de minimis matter, but also 1.35 and volumetric optionality. So thanks very much. Scott, did you want to say anything?
Sure. I appreciate you putting that into circulation. And it's important to take these roundtables and make something of them, because if it's worth fixing, it's worth fixing right. And I think we're making some headway on special entity definition to make that a rule instead of a lingering no action. I'm pleased that we're having circulation or out for comment changes to the data rules as well. So some of the other weighty issues that we're going to tackle here include 1.35, which I know we've heard from a lot of end users, the impact of that, volumetric options. I'd like to see further action to make our hedging definitions consistent and fair and consistent with current action. I think that's something we ought to address going forward in the future. And I know we've got a variety of rules that have a slightly different take on what's allowed for hedging, but I'd like to have it a little more conforming and consistent. So I look forward to today's meeting. Thank you to the chairman for initiating these meetings, and I look forward to actual action once these things are finished. Thanks.
Just one other thing, Commissioner Malley reminded me of it when he made his remarks. We haven't made an official announcement yet, but we've begun discussions this week after some good meetings earlier in the week with my friend Todd Kemp, who's here today. But we're going to have, at some point in the near future, another session either through an advisory committee meeting or a roundtable. But we'll have a session on anticipatory hedging, which is something that there's been a lot of interest in on the part of the end user community. So once the details on when and how to put that together are sorted out, we will make an announcement concerning that, but I imagine that'll be sometime in the next week or two. We make the announcement and hopefully have the meeting or the session itself soon thereafter. So be on the lookout for that as well.
So before we get to the substance, I just have a couple of instructions from our technology department about how the microphones and recording system work. So please be aware that the microphones are pushed to talk. Please keep the microphone a few inches away when speaking. Press the white button on the base before you speak. When your indicator light appears red, your microphone is on. When you finish talking, please press the microphone again to turn it off. A limited number of microphones can be active at one time. Please turn your microphone off after speaking to allow others to speak without issues. Please refrain from putting any mobile cell device on the table, as they may cause audio interference. For the teleconference participants, it is listen only. And for recording purposes, please be advised that this meeting is being recorded. So this panel is here to discuss Regulation 1.35, which is one of the Commission's record-keeping rules. It applies to futures commission merchants, introducing brokers, RFEDs, and members of a DCM or CEF. It actually pre-exists Dodd-Frank. It's been in the books for a long time now, but in December 2012, the Commission amended Rule 1.35 to conform existing record-keeping requirements with new record-keeping requirements under Dodd-Frank that apply to swap dealers and major swap participants. Some of the big areas of change were to put in the rule that written communications include any communications that lead to the execution of a transaction in a commodity interest or a related cash or forward, and that such communications include electronic communications like emails, instant messages, and text messages. That part of the rule applies to FCMs, IBs, RFEDs, and all members of a DCM, and per the amendments, also members of CEFs, swap execution facilities. The other major change to the rule was promulgating a oral record-keeping requirement, and that's basically telephone and video recording. That part of the rule applies to FCMs, large introducing brokers, RFEDs, and certain members of DCMs and CEFs who are also required to register with the Commission with certain carve-outs within that group. Also, where the written records requirement applies to commodity interest and related cash or forward transactions, the oral record-keeping rule only applies to commodity interest transactions. And a commodity interest is defined as a futures contract, an options contract, Forex transactions, and swaps. So we've heard a lot from market participants about challenges with complying with these new rule amendments. And we do appreciate, even during the rulemaking process, we had a lot of discussions, and we've also had a lot of discussions since the rule was finalized. And so we're here today to discuss some concerns from the end user part of the markets. We have a couple of representatives from the commodity trading advisor and commodity pool operating community. And then we also have some representatives from third-party technology vendors who are actually providing some of the record-keeping solutions that are available today. So I would just ask, I'm just going to pose some questions to the group. And if you do volunteer to respond, if you could just introduce yourselves, the entities you represent, and what status those entities have in the market, if you're registered, what your registration status is. So the first topic that I wanted to discuss was the term related cash or forward that applies to record-keeping obligations for written communications. Under Rule 1.35, a related cash or forward is a purchase or sale for immediate or deferred physical shipment or delivery of an asset related to a commodity interest transaction, where the commodity interest transaction and the related cash or forward transaction are used to hedge, mitigate the risk of, or offset one another. Can someone here speak to how that definition relates to your business and how it might provide some challenges with keeping records of your written communications?
Katie, thank you for the opportunity to the Commission to come and work through these issues today. My name's Eric Perry. I'm with the Schooler Company in Overland Park, Kansas, and we are cash commodity merchants. Our business is buying, selling, moving, managing the supply chain on cash agricultural commodities. So the way that 135 is written and the related cash or forward captures every conversation that we have. Leads to the execution, captures every conversation we have. In this space, we do not do customer business. Our entire derivatives book is to manage our own internal risk. And everything that we do is buying, selling, and moving that cash commodity. So our merchandisers, every conversation they have every day, unless they happen to be talking about, to a buddy about fishing, has to do with cash commodities, purchase, sale, or movement thereof. So the dialogue that takes place from the time they hit their desk until the time they leave is captured in 1.35. So it significantly impacts the business that we do.
Excuse me. Is there anyone else who wanted to comment on the definition of related cash or forward?
Katie, this is Lance Kochwar with Gavilon, and I'm here on behalf of the Commodity Markets Council today. Just to follow up on what Eric said, thanks for having us here. We think there's important issues. It covers the whole gamut of what we're doing, but I guess the real challenge we have is when you look at related cash transaction and you combine that with the notion that these records needs to be indexable and searchable. I'll use an example. We're normally around harvest time, we're long physical, so we're short on the exchange. And then in the days and months after that, we are merchandising our grain. So in any given day, we'll be buying and selling at many locations. So if we're I don't know what our average volumes were for this week, but let's just assume that yesterday we netted out being we sold out physical of 500,000 bushels. So what we're going to do, we're probably going to go reduce our position on the exchange. But that net effect is made up of literally hundreds of physical transactions. So for us to be able to, we can capture all the conversations and communications, but trying to tie them back to what we do on the exchange would be, looking for a needle in a haystack. We can do it on the aggregate, but I don't know what that gets you. We have all of our contracts for our physical transactions. That's what we find in our business needs to, and that's all we need to keep. We don't find it necessary from a business perspective to keep all the chit chat, instant messaging. Well, instant messaging we are keeping actually, but we normally would not be keeping that because we don't need that to prove our physical business. So we're scratching our heads wondering if we really are complying when it comes to making these things indexable and searchable. We've got them, but to tie them back to any particular transaction, we'd have to talk about that and figure out what that exactly means, because it's not a transaction, it's hundreds of transactions.
So Lance, just to be clear, you're referring to the requirement that records be searchable and identifiable by transaction and counterparty.
Yes.
Is that right? Okay. Thank you. So we've actually heard this issue quite a bit about concerns and challenges with complying with that part of the rule. And I thought perhaps Mr. Russo could speak a little bit to that as a technology vendor.
Hi, and thank you for having me. I work for Global Relay, and we are a cloud-based archiving vendor, and we deal with these kinds of issues every day. We've got, I'm going to say, nearing 100.
John, could you pull that a little closer?
Sure, sorry about that. We've got close to 100 CFTC registered organizations that use our services today. And what I wanted to add along the lines of what Lance had mentioned was that although we can archive and index and serialize and store this data in worm-related storage facilities, the challenge that would come up for most organizations is how do you track down by transaction ID? So we can index the data, and we were having some conversations earlier, where you can search by the actual transaction ID number and retrieve anything that's relevant to those numbers or the custodians that might have been dealing with that transaction. But it becomes complex in that the organizations would have to follow a strict template-based policy within the organization to make sure they included those terms in all of their communications, so that way it can be tracked. So with respect to email or instant messaging, email might be easier if you've got a disclaimer and you're adding some sort of transaction identifier to the bottom of an email, and that could be company policy. It may not be ideal. But when you get into the space of instant messaging and SMS, that's where you're going to come into some issues. And I think the challenges that a lot of these member firms are going to have is trying to tie back specifically to the transaction ID. So although you can go back and say, well, I know these 15 custodians might have been involved in that deal, I can't necessarily pinpoint that transaction ID within the communications, and it becomes a bit onerous to then try to gather this large amount of data and then cull it down. So the technology is there to grab and capture and retrieve all that information. I think the challenge is more in culling down that data and producing what's required.
Is there any way to automate the assignment of a transaction ID?
To some extent. Again, there are electronically based policies that you can implement in the technologies available today, whereas if you're hitting on certain keywords or phrases, or if you're using internally published documentation as a template that you're distributing to your clients or you're using for communications, you can then apply these policies on the fly, so that when the communications are being archived, they're being scanned and indexed, and then anything that triggers those keywords or phrases or meets the rules of the criteria that identify them as a transaction, that you could pick up and capture that information to sort of do it automatically. But my understanding of the transaction ID is something that is a bit more difficult to capture versus, let's say, some sort of sales or marketing materials, along those lines. There's not necessarily a consistent format to look for, and that would be the challenge.
Katie, my name is Jerry Jeske, and to add to what some of the other folks are saying, I'm Chief Compliance Counsel for Mercury Energy Trading. We have offices and facilities in over 5 different continents, several different countries, different languages, dialects, and so forth within our organization, not to mention with people we deal with internationally. We're an energy end user. We buy, purchase physical commodities. We are in the chain of commerce. We're not members, though. We're not members of an organization. I think Mr. Russo mentioned that in connection with some of the other gentlemen that just spoke. I think the key concept here is membership. If you go back and look into the Reg 1.35 and its iterations over time, back from December 48, 1963, 1971, and as recent as 2009, that concept has been universal throughout each one of the changes in 1.35. Membership meant something back then. Membership doesn't mean as much today. Membership is something that was referenced in every one of these regulations that changed over time as somebody who stood in the pit, somebody who dealt with customer orders, somebody who had an obligation to keep an audit trail related to those orders. What this new change has ensued is an expansion, a vast expansion, past the individual who's a fiduciary responsible for the execution of that order and has gone into customer activity. Customers here are not addressed in the statute. I certainly don't believe that was congressional intent whatsoever, but somehow it's worked its way into this regulation that now customer communications are supposed to be logged and monitored. Let's not forget something. The U.S. sentencing guidelines for corporations require not just maintaining and archiving, but surveillance. These things cost a lot of money. So, do you want to be a member of a DCM or SF? I think that's a big dollar question as it relates to 1.35. Some of the technology may be out there, but when is a trade a trade? When is there a meeting of minds over the phone or on an IM chain? You can't get that deal ID number until there's an actual deal, I would assume, Mr. Russo.
That's correct, yes. Yeah, I mean, just to expand a little bit upon the supervision aspect of it, because we've been in that space for quite some time. not just while I've been with Global Relay, but in the past I've worked with organizations to deploy supervision platforms. What I can say is that the technologies have come a long way, and that it's become much more affordable today than it has been in the past. And I agree with you that in the past, you had to deploy significant infrastructure in-house to manage that kind of supervision, unless you were manually going to print out emails and read them. But today, with the technologies that are available, it's quite affordable and approachable to even the smallest organization to employ those technologies. But that being said, like I said, the main challenge that I see from a technology perspective is identifying the transaction IDs. And I think that language, as it stands in the documentation that was forwarded to me, would be the more challenging bit for us to meet for our own clients. So if we go in and they say, okay, how do I do this by transaction ID? I can simply, everything's indexed and I can search for those transaction ID numbers, and I would assume that I would get some of it. But I think it would have to be worked hand in hand with the policies that are written up in-house within the organizations on how do they address their transactions. So it would be a combination of the actual employees that were performing those transactions. You would search for their data during the time frame that the transaction may have occurred, maybe a few days prior, a few days after, or even longer, depending on how long it takes to lead up to a transaction. And then you would have to cull through that data. But the data set is not as monumentally sized as it might have been in the past. So in the past, if you were pulling all data for John Russo, for argument's sake, for a period of 3 months, you've got this large data set. Today, with the technologies that are available, and they are affordable, you can put some keywords and some logic into your searches to say, I'm searching for all of John Russo's email during this date range, but they might be communications that are only external to the organization. With these keywords, put in the transaction ID number. You could put in logic like ands and ors and proximity, this word within this number of words of the other, and you can cull down your data set. And that is where the power of the newer available technologies comes into play, and I think would be a resource for most organizations today, with, meeting these regulatory requirements.
Katie, Eric Perry, I think it's important to take a step back here, and I hate to get too far down in the weeds, but to realize that, again, as a cash commodity merchant, we have a book of derivatives that manage risk, and we have a book of cash. We don't tie those two together except as net positions at the end of the day. So as we go through the day in our shop, buying and selling cash commodities, that individual merchant may or may not lay off that risk at the same time they do the trade. They may have already had a position that wasn't even, so maybe they needed to buy some more corn or sell some more corn, and that evened out their position. Or maybe they actually pick up the phone and give that futures order to a central order desk that then executes it on the exchange, whether that be Minneapolis Grain Exchange or the Chicago Board of Trade. But we do not keep that commodity interest transaction and that cash or forward transaction. We don't tie those together by any number. We don't do it. We don't have a need to. We keep the pertinent economic terms of the cash trade, because we'll need that in the future should we be in an arbitration case or litigation. And we have our derivatives hedging book. But we don't match those up. I mean, we don't take a 5,000 bushel corn trade that happened with a producer in the middle of Nebraska and tie it to a 5,000 bushel corn contract that was executed on the Chicago Board of Trade at X price. That's not what we don't need that kind of detail in our business. We don't need it to manage our business, so we don't track it. So I think the gentlemen that have the technology, I think capturing all this information in aggregate can be done, but again, bringing it all together is a significant challenge for our business. We don't need to do it. We haven't done it in the past. So it's changing the way we do business. It's going from the least efficient, the most efficient mode of operation to a much more structured and higher cost mode of operation.
Todd Kemp with the National Grain and Feed Association. We represent about 1,000 companies nationwide, about 7,000 facilities that handle grain or feed manufacturers, oilseed processors, and these are the traditional agricultural hedgers. Eric's firm and a couple of others around the table happen to be members of our association as well. But, you know, what Eric's describing is exactly right, and it's extremely widespread. If you think about 7,000 or 10,000 overall facilities that potentially could have been affected, we were encouraged when the final rule was published that the majority of our member firms, you know, had their problem taken care of on the cash side. And we appreciated that, but there are still a number of firms who are members of a DCM who are affected. One of our concerns all along has been that what we're looking at here is kind of a bifurcated marketplace where you've got DCM members who are required to capture this information, then you've got other firms that are not required to capture it. And, you know, if you're a farmer and you're talking or texting to your elevator, who do you want to do business with? The guy who has to tell you, hey, this is all being captured for posterity in the CFTC, or the guy down the road who's not? So I don't know if that goes directly to your point, but we do have some concerns about an uneven situation being created in the marketplace.
So I just, some very good points were raised in terms of different parts of the rule. So I just wanted to focus on a couple of them. And at first we were talking about the definition of related cash or forward, and but then also I think what we're talking about in connection with that is the definition of member that applies to the rule. So just to take us back to related cash or forward, do you have any suggestions for?
Okay, so tell me, so I can't minimize the screen? Because how do I go back?
Can someone, can you please mute your phone?
Okay, so just,
Is there somebody can help with this? Please mute your phone, whoever is on the line that we can hear. Okay. So if anyone wants to speak to that.
Katie, this is Lance with Gavilon again. I guess let's just assume for the moment that we can come up with something that's somewhat affordable to be able to track all of our related cash transactions back to futures. I guess from my perspective, you know, I know we've touched on the issue of what members is. My company doesn't have a fiduciary duty. We're a grain merchandiser. So even if we collect all this, what are we going to do with it? I don't know what you would do with it. If you go back and look at the way the history of member is with the fiduciary duty and having, you know, responsibilities to track something for a customer, it makes perfect sense because you had two ways to do it. Is your customer a hedger or a speculator? If your customer is a hedger, then you would expect there to be some sort of related paperwork related to the physical side of that. But for us, because of this application of member in this instance, we don't have that relationship, and so therefore we can't pick and choose on this. We're just going to have to record everything. We're going to have to collect all of this stuff. It's useless for us. We can talk about that more later when we talk about implementation challenges, because I've been collecting instant messaging for 2 years. Never once looked at it. Doubt if we ever will, because from our perspective, the commission has a much better way of figuring out whether they want to come ask us any questions with our large trader reports and our monthly 204 reports. We're a big company. We have lots of positions on. You can figure out from our other reporting whether or not you don't want to come knock on our door and give us a special call and ask us anything in particular. But I just don't see this, even if it was affordable. I don't know why anyone would ever want to look at instant messaging and text messaging related to hundreds of daily transactions leading to cash contracts that are net hedged at the end of the day. I can't see that being useful information anytime.
I would add to that. I think the history of 1.35 is actually informative. That's why I mentioned it earlier. And I don't think you can really bifurcate the concept of who it's aimed at from this concept of related. And this related, or the other language that sneaks in, is leads to the execution of a transaction in a commodity interest or related cash or forward. So to expand on your question a little bit, that language was nowhere in 1.35 before these conforming amendments, so to speak. If you go look back in in time and back to 48, the reg said FCM and members of a contract market shall keep records of futures or cash transactions made by or through him. Him, the person in the pit. Those are customer orders, again. So where this expansive related language comes in, to me, is rather misplaced. As an energy end user, we have people out in the field. As we all know, there's a huge energy boom right now by virtue of the fracking. You have people out in Eagleford, Texas, who are texting because that's a mode of communication. They are primarily responsible for finding the crude out in the field, bringing it to market, whether they do so by train or pipe, and the ability to be able to go out there and make deals and make transactions with those people in the field is crucial to be able to supply the energy to America, really. But that doesn't happen seamlessly without the ability to pool those resources and then bring them to market. That process requires price exposure. That price exposure, yes, it is hedged in the derivatives markets and the OTC markets. But to rest your hat on related to and say all of those communications need to be captured, I think is just simply overreach by the Commission and should really be looked at closely because, again, it goes into the customer activities as opposed to that which is being affected in the ring. The ring is a dinosaur, right? Now we're talking about ether space and electronic executions. I really question how this impacts CEFs more than it does probably DCMs, but it impacts them both the same, I suppose.
So I think one of the fundamental issues that we're hearing about is the definition of member, which is what draws in, I think, a lot of market participants to the written record keeping requirement, and then fewer market participants to the oral record keeping requirement. But I would just be curious to hear about what you all think of as a member as opposed to what our statute says as a member. And our statute includes anyone with trading privileges, which is, I believe, the part of it that sort of draws in a lot of market participants who wouldn't otherwise think of themselves as a member.
Hi, Katie. I'm Robbie Sen at Ameriprise Financial. Our subsidiary, Columbia Management, is registered as a CPO and a CTA. We're also a member of a CEF, so we're pulled into 135A, both for the oral and written record-keeping piece. And I think, as Jerry was saying, the legislative intent of 135 is never meant to take in customers or anyone who's basically a liquidity taker, not a liquidity provider, and not an intermediary. And I think as it relates to CEFs, one of the important points is that the final rulemaking of 135A was published in December 2012 before the final CEF rules were published and before the first CEF rulebook was published. So asset managers like us who are registered as CTAs had no idea that we would even be subject to this requirement because we didn't think we'd be members. And then as the CEF rulebooks came out, more and more of them had said that if you're a market participant with trading privileges, then you're a member. Our view is that membership on a CEF with trading privileges should not make us a member. We don't take customer orders. We don't deal in commodity interests. And that dealing in commodity interests is highlighted in the rule. And I think we're having serious thoughts internally about whether we want to be subject to CEF membership. And it's for various reasons, but 135A is a big part of it. The rule books are onerous, and that's probably a different conversation. But if we're going to be subject to 135A, we're seriously going to consider other alternatives, trading different products, possibly using an aggregator. And I think there's been some developments recently in the market with some of the CEFs even coming out and saying that the participant itself could be an account, so like a mutual fund and not the investment advisor would be a participant. I think one of the main reasons is that people want to get out of 135A, and I don't think that's one of the intents of the rule, is to pull in people that don't take customer orders.
If I can just echo that, I'm Steve Waldman. I'm a managing director and deputy general counsel at Tudor Investment Corporation. We've been registered with the CFTC as a commodity pool operator and a commodity trading advisor since the mid-'80s. We're also registered with the SEC as an investment advisor. And we're also a member of the Managed Funds Association, where we've been dealing with this issue on a regular basis over the past year. Again, I just to follow up on what Jerry and Robbie have said, I think the definition of and what it means to be a member has changed over the years. Initially, if you look back a few decades ago, what it meant to be a member of a DCM was if you're acting basically as an FCM or a broker or in some intermediary capacity. And probably the trend over the last decade or so has seen more entities become members, not in their capacity as an intermediary, but solely to get better rates on the exchanges. And I think that's played a big role. And then when the CEFs were initially proposed and introduced, nobody really had any idea what it would be to be a member of a CEF. Nobody knew if you would have to be a member of a CEF. And therefore, when Rule 135A was proposed, it really seemed as a non-event for many in the industry because nobody anticipated ever becoming a member of a CEF. So it was only after 135A, as Robbie mentioned, after 135A was adopted, that the rule books were finally published. And even today, it's not entirely clear if you're a participant on a CEF, if that makes you a member. If you have trading privileges, does that make you a member? And I have to say that it's difficult to say that anybody was really given a reasonable opportunity to comment on 135A, given that the rule came out prior to CEFs. We just had no idea what it would mean. And what may have been viewed as a technical amendment in certain instances really turned into a substantive change to the way many of us are forced to do business.
Katie, if I can may add just a little bit of clarity too. Scott Cordes with CHS Hedging. We're registered as an FCM, but I also represent our parent company that has probably over 200 locations buying grain around the countryside. We also have customers that are probably a couple hundred other cooperative elevators are buying grain as well. So they're quite interested in this related cash, how it plays out. And as some of my other colleagues talked about, they're looking at their aggregate positions every day, typically handling customer orders. But some of those folks are members of exchanges, and this is the part that causes some heartburn. What does that mean? Typically in the past, they become members to have some input around the hedging and viability of those contracts, some good order, but also for their volume such for around exchange fees and what they're paying. So there is a reason for that. Are they trading directly on those exchanges? Typically not. They're placing orders through an FCM like ourselves, but they're starting to ask themselves, should I continue to be a member? Because now I get captured in some of these rules. And with some of the areas they're operating in and the advent of technology, people want to use a lot of different social media to communicate. It's hard to comply with that on a cost structure that's cost effective for them. So that's some of the clarity that we see on the grain side of this issue.
I was going to make just one comment. I think it might be important to point out again, which I think is an obvious one, but the purpose, I think, at least as I envisioned it when this rulemaking was being considered, the real purpose behind this rule was that it enhance the capabilities of the enforcement division. This is an enforcement rule more than anything else. So it has both a deterrent effect through entities complying, but it also has the effect of assisting with respect to investigations if one is initiated. So I don't think it's difficult to argue that there isn't a legitimate public policy purpose behind the rule. The real question here, I think, is, are there other public policy objectives that are somehow thwarted given the scope of the rule and upon whom the burden lands? And to me, that's really the most important question. I feel like we're talking about that a little bit, but I just wanted to point that out because there is some utility, even if, let's say hypothetically, there's an enormous amount of records kept, oral records, even written ones, that never get read. I think there's still some purpose behind the mere requirement that the records be kept. Again, the better question is the scope correct? Is the cost-benefit analysis working out in favor of the scope of the rule as currently drafted? So I do think, we're here to solve problems, but even if we were to do nothing, I think it is, again, important to just say that there is some purpose or utility behind the rule, even as it is written now. But what we want to make sure is whether we've got that balance right, whether we've got the scope right. So enough on that for now.
Can I follow up on that a little bit? Because I think what Robbie mentioned, if membership on a CEF dictates who has to record and who does not have to record, and people choose to either use alternative means or they go through an introducing broker of some sort or aggregator, then you're going to create an incentive not to record. So is the right answer under your scenario, Mark, to apply that and have the introducing broker therefore record all of its customers when this was a customer rule as opposed to a membership? This is all very, we've clearly identified workarounds to avoid this thing that I don't think were contemplated or priced into the cost-benefit analysis when that was done. And then, to your point, if keeping all of the data is important, how would you address the workaround issue that is an obvious issue?
Yeah, I think that's a great point, and it relates to what I said about, whether there might be other policy objectives of the commission that are somehow thwarted by the current scope of this. And obviously, we want to see as much participation on CEFs as possible. And so, to the degree the current construction of the rule is standing in the way of that, that's something we need to take a careful look at, which is part of the reason we're here. The other thing I would add is, in talking to some of the asset managers in recent weeks about this, and I'm not sure whether it's on the list of questions, but it is something I'd be curious to hear some thoughts from the group on. If there's duplication in the record keeping in any sort of meaningful way, in other words, if we know a conversation, let's say, is captured by one of the participants in the conversation, so we know the conversation is recorded by someone, is it necessary that both parties are keeping the same recording? I'm not so sure. Just the mere fact that you know that someone you're talking on the phone with is recording the conversation is going to have some impact on what you say, at least in my experience.
That gets back to the customer-member relationship again, and that's broken down in this rule. It just doesn't function the way it was supposed to function. Maybe DMO can reflect on how you intended kind of the CEF rules to serve on this and what the appropriate membership requirements were and what you intended to capture. Maybe, David, you weren't the right guy to ask. I do note that none of the people who wrote this rule are at the table. You were there,
it's
weren't
certainly
you?
something
Yeah.
we can follow up on, and we can discuss at another time.
Microphone.
It's certainly something we can follow up on and check with the appropriate people on that.
But I think this is a good line of conversation because and we can tie in here, there's a bit of an inconsistency as you think about these records and you think about the carve out on the oral. So on the oral, for our organization, that's not a registrant, there's a carve out for oral recording. We're out of the oral recording piece. But yet we're still handcuffed to the electronic written record keeping rules. The obvious answer for us in that environment, and this is not to skirt the policies, because we want to work with the commission to make this rule workable and to make the market better for everybody. But the obvious answer for us is to push all of our trade to the phone, to just simply through policy action limit the conversations that take place about the related cash or forward transaction to the phone. And there won't be any of it that will be recorded. So there seems to be along those two lines, the information is either important or it's not. And we've worked with the commission in the past, specifically on the Chicago wheat and Kansas City wheat convergence issues. And we've extracted from our systems all of the cash information to help the commission determine what was going on with convergence in those futures markets. And I think through working together came up with good answers in that arena with relevant economic information. It's economic terms of the trades, the contract prices, the basis, contract amendments, but not this enormous amount of dialogue that happens every single day. Let's get down to what really makes a difference.
So if I can just respond to that as well. I absolutely agree with everything that Eric said. And if there was a policy reason to push trading onto CEFs, this is a disincentive for people to actually do that trading. Just to respond to the question about asset managers, there's a specific carve-out that was written into the rule for exemptions for commodity pool operators. And for whatever the policy reason that whatever policy the commission was following in pursuing that exemption, it's not clear to me anyway why a commodity trading advisor wouldn't be similarly exempt. I just haven't been able to find a distinction in policy between the two.
And just to add to the point of duplication, I mean, I think as a CEF member and looking at our commodity interest trading, anything that we do on an exchange through a CEF is subject to the CEF record-keeping rules, and the CEFs impose record-keeping rules on their members and participants. And every single other bilateral trade we do that's off an exchange is presumably with a swap dealer who's subject to the Part 23 rules or 135. So those conversations are getting recorded. And I think this goes towards the interpretation of the rule, where the rule says provided or received and leads to the execution of a transaction. I mean, we're interpreting that to mean external communication. So if our portfolio manager talks to our trader about an order they want to do for an account, we don't think that should be recorded, but I don't think it's clear from the rule that that's the case. And so that's just one of the challenges that asset managers face in trying to comply with the oral record-keeping rules, and why first we think there should be some exemptive relief. If not, we think the no-action relief that was provided up until May 1st should be extended, because it's pretty hard for us to be able to comply and know what the costs are when we don't know what the scope of the rule is. And then if it does lead to less asset managers accessing CEFs directly, I mean, I think it'll go against congressional intent and the intent of the commission to increase liquidity and transparency in the market, which is what the CEF rules were intended for.
I think the concept of cost was addressed. I don't know there was a cost-benefit analysis done in these conforming amendments. It may have been done, but I really don't
We do one in every rule. I mean, we're required to, so.
Well, I guess I wonder if that cost-benefit analysis, given the fact that the amendment to 1.35 was driven by enforcement, was done in a way that really evaluated the costs associated. So I think you brought up a concept of if one party keeps a communication and another party does not keep that communication, is that okay? Is the redundancy necessary? The cost of keeping isn't the end of the story. The cost is much greater than that, because when you're looking at archiving information for 5 years in some searchable format, and then surveilling that information, if you're a U.S. corporation following the U.S. corporate sentencing guidelines, there's a surveillance cost associated with that. Human resource cost, systems cost. In addition, when you get that lovely letter from enforcement that asks for that information, you have to employ counsel to go through all that information. You have to search that information for that which has been requested. Those bills are extremely expensive. So the cost associated with 1.35 doesn't just stop with archiving it and sticking it into a cloud someplace. It's much greater than that. And I really don't think that part of the cost-benefit analysis was really addressed. And it would be something that I think anybody would ultimately face if asked for that information down the road being maintained for multiple years. There's another point too with regard to CEFs, and the mistake that I think is occurring in Europe with the multilateral trading facilities and how a derivative contract is deemed within scope. Many folks who used to participate on electronic screens are now going to the phone, as Eric mentioned. Similar to CEFs here, if the goal is to participate in CEFs, who are glorified voice brokers, there seems to be a disincentive to use their electronic matching systems or any systems for that matter. And why not just do it the good old-fashioned way and continue to speak over the phone? Now, certainly the Commission could come out with another rule amendment which would capture audio, but I think we all know the costs associated with audio and searching and surveilling for audio, which is astronomical.
Maybe Mr. Powell, this might be a good place for you to.
Good morning, Robert Powell from Atrali Trading Solutions. We provide voice recording integration for fixed line and mobile call recording. Our business on the mobile side started up in Europe a couple of years back when the FCA introduced that. And actually we have cloud-based solutions for both fixed line and mobile recording globally now, so based on the AT&T network over here. I think that in terms of cost, you make some very good points about the total cost of ownership not just being the capture. And I think there's also been some good points made about not storing for storage sake. I think that's a very important point. I think we have really witnessed some major changes in the way that the total cost of ownership has been driven down over the past few years, particularly to do with voice, which is about 12 times greater the volume of your electronic communication. So I think the solutions that are now out there in the market give you some very good ways of accessing that data from the metadata to allow you to match a conversation to a transaction, and also give you some very good ways of actually searching inside that data without huge expense. So I think there are solutions out there now, and they can range from smaller solutions to larger solutions.
So that's converting voice to text, yeah?
We tend not to go down the converting voice to text route. We allow searching inside the conversation. The conversion is problematic. Being able to search inside it is a better way of doing it.
Yeah, it's very problematic. In terms of being able to archive that information, though, I think we're stuck with the same thing. When's a deal a deal? And how do you reference a transaction ID to something that isn't even a deal yet?
Yeah, I think we've heard from Mr. Russo this morning, and I think there's a number of different elements of this, which I think are kind of coming together. There are a lot of conversations in the market which are not about an actual transaction. You know, if you're a lot of the conversations about the relationship management, about maintaining your relationship with your customers, with your counterparties in the market. However, there are also conversations which indicate pricing or which lead to transactions. I think it's impossible to try and go down the road of pressing a button on your phone or on your email to say, I'm just about to talk about a trade that might happen in the future. So to the extent that you are recording everything or you're capturing all of your data, I think the tools give you some very good insights into the way that you can cull down very quickly to a level where that reduces your total cost of ownership, particularly for those investigations. So if you get to the point where you've got an investigation about a particular custodian with a particular counterparty or a particular transaction, to your point about the cost of the legal fees involved, I think you can get down to a point where the severely reduced number of conversations that you're actually going to be giving to the legal counsel and then on to the commission can really be culled down quite quickly.
Yeah, and I just wanted to add, with respect to storing all of this data and whether it's actually useful to any organization, I think with respect to litigation support, it's an asset that every organization has to have all of their data archived. The large majority of organizations out there are not doing illegal transactions, and they're not violating laws that they're getting accused for. And if you don't have the archives and you have nothing to go back to justify your position, I think that's more costly than not storing the data and spending a few dollars a month. Yeah, is it an extra hoop? I absolutely agree it is an extra hoop. And it's probably something that if you're a trader or a broker, you really don't want to deal with these complexities, but it's just a fact of life today. Everybody's got an electronic device, whether it's a BlackBerry, an Android phone, or an iPhone, that if you honestly believe that these communications are not occurring, I think we're putting blinders on. It's something that we have to address moving forward.
I'd like to add just one point to that, which is in terms of having this data and using it usefully, we're seeing quite a large emergence of what we call voice intelligence, which allows you to link the data that you have and the way in which it's been collected into your CRM solutions to allow you to manage your business better. So this is not just about necessarily complying with the rules. You can now get intelligence from that data about the cost of doing business with a particular client, how many times you have to call a particular client to get a trade. So there are other reasons why you might want to keep that data apart from to give for regulatory reasons.
Lance, I think you wanted to say something.
I do. I want to reel this back in from those of us in the membership area who are really just customers and end users. Let's take a typical conversation that Eric and I are going to have. He's a farmer. I'm a merchant. He's going to call me up and ask me what I'm paying for corn today. I'm going to tell him. He's going to offer me, say, well, what if I give you this many bushels? We'll arrive at a deal, right? Right now, we can have that conversation on the phone. I'm going to follow it up with a contract. Probably it'll satisfy my need to have business records. Today, this is a challenge for us, okay? That's going to be the large part of our origination business. It's conversations with farmers. Today, most farmers or many farmers would prefer to have exactly that same conversation via text. It's a lot more efficient, and that's the struggle we're going to have. If we're not going to distinguish, there was a policy reason why you created an exemption for oral recording for people like me, leaving aside for the moment how we got here with all this membership history, but you're forcing me to do something the 20th century way on the phone because I can't, especially with the mobile devices. Despite all this, I'm not going to take that step yet. You know, grain origination is a fairly low margin business. I'm not going to get this high tech about it. We're talking about exactly the same conversation. And if I do it on the phone, it's an oral communication. If it happens over the same phone via text messaging, it is now a written document that I have to record. And that's inconsistent, and it's one of the things that's driving us crazy.
I agree. That seems odd.
Very odd.
I'd like to add a point similar to Lance's, but from a different perspective. My name's Eric Smalley, and I'm from Growmark. We're a regional agricultural cooperative, and we serve about 250,000 farmers in the Midwest and in Ontario, Canada. We also operate Midco Commodities. We're a small non-clearing FCM that serves price management needs for grain elevators and their farmers. So we're in the smaller end of the spectrum, but we have some of the similar issues. On the one hand, we're very thankful that we've received some relief via no action letter for our branch office operations because they're so small and the cost effectiveness isn't there. But then even in our home office, we've got similar issues where it's changing how we do business. We've already got record-keeping requirements, and our phone lines are already recorded. To terms of technology and whether it's affordable, I would say it's a relative term. And for a smaller firm, that bar is a lot lower for us. And so it's hard for us as a cooperative to justify any additional investment in technology that's not going to bring value to our customers solely to help enforcement issues that might or might not come down the road. So we've been forced at the moment anyway that we drive all of our customers back to phone and email, things that are already captured. And so, for that possibility, it's changing the way we do business, which isn't helpful for our customers.
Can I just pose a question regarding the membership issue with regard to storage of written communications? There was a DMO advisory in 2009 that spoke to the written communications requirement and the fact that it was DMO staff's belief that that included emails, instant messages, and text messages. And I'm just curious to know how you all interpreted that advisory. It's 5 years ago, but.
From my perspective, a better question would be, was I even aware of that advisory? And the answer would be, I'd be very diplomatic here, no. This became an issue when that that little bit of information got rolled into the final rule. Okay, but I don't want to get into a lot of the other issues that this has given us angst and consternation over, but I would say that I haven't talked to anybody who was even aware of it.
Katie, I would respond as an FCM, a registrant. We got that advisory. We put in some changes to start recording our IMs, that kind of thing, so we looked at it. But I would tell you from some of our customer standpoint that's a member of an exchange, I doubt they ever looked at it. The chairman's question about doubling up on some of this recording, I would say those folks that are a member of an exchange, their derivatives activity, whether it's futures, options, or some sort of swap, is going through a registrant like ourselves. We're capturing that information. So it sounds like, why should they capture on the other side? There's probably some redundancy there that could be alleviated.
On page 2 of the advisory, the term member is footnoted, footnote 4, which references 4G of the Act. 4G of the Act says FCMs, IBs, floor brokers, and floor traders. Does not say customer. February 5th, 2009, Division of Market Oversight.
And Katie, I think Eric Perry, and not clearly didn't have any conversation with anybody on the commission about the 2009 advisory whatsoever. And I think to Lance's point, I think Lance is right. I think those of us in the member space at managing our own accounts looked at that 2009 advisory, and our world of member is that person that has fiduciary responsibility and handles customer money. And right, wrong, or indifferent, I think that's probably how, even if you were aware of it, as Jerry points out, I think most people would interpret it that way, most of us in our arena. But I do think the footnote is telling relative to the definition of member and how far we've drifted from what the original intent of member was to where we are today in this Globex screen trading world.
Just to follow up on that a little bit, I mean, we've heard all the elements of where we think this needs to go thrown out today. You know, fiduciary duties, customer dealing with other customers' funds, whether you're otherwise required to be registered. I mean, those are 3 elements that separate all of us who have the most heartburn about this from anybody else. We're not otherwise registered. We don't deal with customers. We are the customer, and we have no fiduciary duty. So that seems like those are common elements to everybody who's really got rash about this.
Katie, one quick comment here. You know, as we step back a little bit and look at it from an industry perspective in the grain industry, for many years our industry has relied on cash generally being excluded from CFTC jurisdiction. You know, there's a cash forward contract exclusion. The Commission's oversight mandate is really in futures markets, right? Our members fear that if you're taking this deep a dive into cash markets on a regular and ongoing basis, you're really blurring the lines between the two.
So I'm just curious to know, I mean, more from the way my lawyer brain thinks, if there are places in the rule that you think could possibly be amended, or if there's guidance that the Commission could give to sort of alleviate your heartburn, Lance.
I got my mic on before Lance. So Katie, I'll go back to the 2009 guidance. I think that the term member in today's world doesn't fit anymore. I think that needs to be removed. Now, I can't sit here and tell you that I have a confident answer on exactly what needs to be replaced with that. Is that registrant, or is it that list of 4 or 5 that was present in the 2009 guidance relative to this kind of communication? But I do think that's the most direct and most efficient answer to that. And to Robbie's point, I may not be in the right spot, but I'm not exactly sure in the carve out why CPOs were carved out and CTAs weren't. I think there's a lot of issues around membership that need to be fine-tuned, and I think we probably need to go to a black and white list like the 2009 guidance did of exactly who falls into Part 135.
I think the CTA exclusion was mostly based on the fact there's some semblance of a customer relationship there, unlike a CPO. Now, I'm not saying the analysis came out the right way, which is why we're here, but that was, part of the thinking at the time.
So maybe Robbie or Steve, you could talk a little bit about, I know you're both dual registered CPOs, CTAs.
Katie, I'm sorry, it looked like you're about to, because you touched on this earlier, so I'm curious if you had a reaction.
Yeah, and I can't speak for obviously all in the industry because CPOs and CTAs come in all different sizes. And I think the answer would be that to the extent that you're an advisor that have discretionary control over money, I'm not sure there's such a distinction between a CPO and a CTA.
But you acknowledge that there is some type of a customer relationship, if you will, between the advisor, the CTA, and the customer, right?
Well, I would just...
It's just the fact that there's discretion in the CTA, it makes it look less like a customer relationship. Is that the point?
Well, that's part of the point. The other question is, in that context, I have no idea what the difference between a CPO and a CTA is, just other than the nature of a CTA may have a CPO has discretionary authority over its funds, meaning its investment funds. A CTA has discretionary authority over its investment funds and its managed accounts. So it may be different for others. I'm just answering the question on behalf of Tudor.
Yeah, I think as a CTA, we're acting as a fiduciary and managing money on a discretionary basis. And I think that in the latest 135 rulemaking, the two overarching goals were customer protection and market integrity. And I don't, in terms of customer protection, I don't see what 135 does in terms of customer protection for a CTA when we're managing money on a discretionary basis. The only question is if we're managing it based on the investment guidelines, not what commodity we're buying and any sort of external communications, as we've talked about, are being recorded. So I don't really see the difference between a CPA or a CTA either.
Do we also need to address the September 30th, 2013, what is a member on a CEF guidance as well, which seems to, that's the direct access that distinguishes if you have direct access versus intermediation, that automatically brings you into that obligation and makes some of these other distinctions irrelevant, I assume.
I do think that would be helpful to address. I don't know if, I would imagine that would be a Robbie and Steve issue again as well. And your thoughts on the guidance and how it relates to this situation?
I mean, I still don't think it's clear what a member is and what trading privileges mean. Because if I'm accessing a CEF through an aggregator and I'm seeing the same view, why should I be treated differently than someone who's a direct member? Or if I tell someone else to execute the order on a CEF, why I should be treated differently? I mean, I still think that trading privileges hasn't been defined. I think some clarity on that would help the industry a lot.
We don't have multiple definitions of the same term, but another way to go about it would be defining membership as it relates to 1.35, right? Yeah.
Unless anyone has anything else to comment on the membership issue, I just wanted to go back to the lead to the execution of a transaction language, and hear from folks on how you're viewing that language today, since we did not define it in the preamble to the rule.
I'll take that, Katie.
Okay.
I can tell you how we've been advised to interpret that. That it's any conversation, however it takes place. If it's in electronic written format, we have to capture it. But it doesn't matter what mode it takes place in, but it's a conversation that ends up, like in Lance's example, a negotiation between a merchant and a farmer buying some grain off the farm, or a negotiation between a merchant and an end user that's buying trains to feed chickens in Alabama. But it's all of the dialogue that actually ends up resulting in the consummation of a trade of a cash commodity. That's how we've been advised to interpret that. And back to kind of where I opened up, and it's hard to draw distinct lines, in the language. We're going to quit talking about this. It all kind of bleeds together. But where I started in my introduction was that basically there are some conversations that take place about customer management, customer relationships that aren't directly related to a trade, but you can't figure out which one that is or isn't when you start to write the email. But that captures everything. So the way we've been advised to interpret that is that all of the dialogue needs to be captured. Now, in a meeting, and I'll get the date wrong, but I think it was here with the chairman this month, last year, or right thereabouts, we had just this conversation. And I think what we as an industry, or the participants in that meeting, heard was, well, that's not exactly the intent. Okay. Can we get guidance on that? And we didn't get that. And I know that there's a massive backlog of stuff and everybody's busy, but that in absence of any definition or formal guidance on leads to, we've been advised that it's any conversation that takes place that ends up in the actual consummation of a cash commodity trade.
Katie, I'd like to just go a little bit further on that. So how we are doing exactly what he just said, because we've gotten the same advice, is we're keeping all email for anybody who's got the ability to sign a merchandising contract on behalf of us. We're keeping all instant messaging, but we're forcing all instant messaging to be originated from systems that we can capture. So the flip side of that is we are on purpose, specifically and very focused, none of our merchandisers are allowed to use mobile devices for anything other than phone calls. If they want, when it comes to talking about cash commodities, those are our rules, because we cannot comply with the mobile devices. We can capture everything else, which I told you we've been doing for a long time now. Welcome to come see it. I'm sure it's gigabytes of data, but we just simply can't do it with mobile devices yet, so we comply by not using it.
And Lance, is that because it's prohibitively expensive for you to keep the text messages?
Well, I'll give you a perfect example is iPhones. Lots of people have iPhones. I talk to our tech people very regularly about this, and I say, hey, is there any new systems out there that we can capture the iMessaging? And I am told that iMessaging is absolutely proprietary. There's no way to copy it other than to make a copy of your screen and email it to yourself as a GIF file. So we don't know how to. So again, there may be some off-the-shelf systems that we can run into with that, but it's a lot more effective for us to just say, don't use them, which, again, that puts us at a competitive disadvantage with our competitors who get to text with the farmers. We only get to talk to them.
Our issue was similar, but then also we didn't go that direction because then we knew we had no way to index those conversations to a particular transaction anyway. So we went the similar route, partly due to cost, but partly because we knew there was no way currently anyway to be able to index all of those conversations to a particular transaction.
Yeah, what we're seeing is a lot of companies are putting in company policy to their employees saying that you can bring your own device and use it for business purposes, but it must comply to company policy and standards. And right now, that's mostly limited to BlackBerry devices and Android devices. As Lance had mentioned, Apple has not released its APIs to any vendor, so we cannot capture iOS-related text messaging. So most every company that we've dealt with has basically just said you cannot use your iPhone for business, and you're limited to Android or BlackBerry, and usually it's company-provided equipment. So this way you could put the controls in place. But if there's one thing I could ask, the regulators to do is sort of, tap on Apple's shoulder and give them that extra nudge that they need to get on board, because every other vendor has done what they've been required to do.
Yeah, I can really echo that. We've had dozens of conversations with Apple directly, and they are fiercely resistant of opening up this capability. We've introduced the fact that the markets generally, and not even just the futures and commodities market, but the financial markets globally are interested in using their devices and would be delighted to be able to capture this for all of the reasons that they need to on the record keeping side, and not been able to make much headway with them so far.
Yeah, I would just echo a few of the comments too. We've put in some policy within our FCM that for employees using cell phones, and it's not allowed for company business. Some folks need to take calls on off hours, that kind of thing. We're providing them with a separate cell phone or a tracking type device, but really we've encouraged the business takes place in the office. Well, that's hard when markets are trading 24/7 and somebody wants to talk to their personal broker that they're comfortable with. It's hard to stop those conversations, but we've really had to really entrench back, and you're not able to use all the tools that are available out in the marketplace is really what's happening.
Hey, just one last thing, and this goes back to the way Eric described the way he has a physical book and a derivatives book. Same with us. So this notion about what does it mean to be indexable and searchable? We do hundreds of physical transactions each day. At the end of the day, we'll probably do some derivatives transaction. We may be doing during the day. The only thing we can do is we can capture all of that instant messaging by day and by person. We can do it by day and by person, and that's as close to indexable and searchable as we can get. Because of all the challenges of trying to tie those back to a particular derivatives transaction, we don't keep our books that way, so we will have all this information by person by day. That's it.
I think we've hit most of the points in the outline that I provided to all of you, but if there are some issues that you feel like we haven't covered and you'd like to raise them, please do.
Katie, I want to echo what Todd touched on a little bit, relative to leads to the execution of and capturing all that information, whether it's in a IM or a text or via email. And again, this goes back to the membership thing, and I think everybody gets that. But it does. I don't think you can measure it, quantify it in dollars and cents exactly. But in this age, with all of the, what we've seen in the news over the last 12 months about phone calls being recorded and, all that sort of stuff that's been in the news, we do feel like those of us that are getting caught in this membership net are kind of at a disadvantage, because we're doing business out in the country with the next 3 competitors that don't have to do any of this stuff, none of it. And when those customers know and hear in the press that, hey, the schooler company's recording everything we do if we send an IM to them, I'm not doing that anymore. Okay, well, if you, like Lance points out, if you prefer to communicate like that, you're in the shop or you're on the combine and you want to do it, then you're probably going to do it to the guy next door to us, because, he's not going to record it. He doesn't have to capture it because he doesn't get caught in the net. So I do think that creates disadvantage is a strong word. It creates concerns for us in the marketplace, given how we've bifurcated the people in our business with record keeping.
I was just going to add to it, and maybe it comes back to the question of, what you're trying to capture, what's the end goal in this whole thing. And I look at it, the marketplace today, most of your derivatives transactions are taking place electronically. There's a front-end system out there that's capturing a lot of the stuff, so I'm not sure what everything else is going to do other than point you where that trade is at the time and when it took place. But a lot of that information is already captured as far as when it traded, how much, and that kind of thing, if that's what you're after.
Well, I think it's pretty clear that the rule as it's written today is a disincentive to become a member of a DCM or a CEF. I know we're in a CEF dichotomy where we're dealing with asset classes that don't have anything to do with energy or grain at this point, but if the Commission's public interest is to see participation in CEFs down the road, I think this rule needs to be amended because, we have no interest in being part of a CEF at this point. And if that's a public policy concern, then maybe the Commission should try to address this in a constructive way to create liquidity.
One of the carve-outs in the amendment was for small introducing brokers, and it was the only area where we applied a size limit. And I'm just curious to hear if that would be effective for any other market participants. We actually ended up cutting out, I think, about 95% of our registered introducing brokers with the carve-out.
Well, Katie, I think that goes to cost. And if there's a proper cost-benefit analysis done, then that would be great. But some of the costs that I mentioned before, I highly doubt if they've been evaluated. Because just because you get a request letter from the Commission, there's a cost associated with that. Doesn't mean you've done anything wrong, but you're compelled to review and search and lawyer up. And if you don't, you run the risk of providing reams and reams of information that haven't been thoroughly reviewed. And, again, query U.S. sentencing guidelines. If you're not already reviewing that, and then you do get, the rogue trader, so to speak, or somebody in the organization that shouldn't have said what he or she said at that particular point in time, because let's be honest, that's what's being looked for. In all due deference, Scott, I don't think they're really looking for the deal execution. They're looking for more. And if enforcement was the motivator behind that, well, I think there has to be a balance, and I think the pendulum swung a bit too far.
I would just say with respect to using some kind of a size gauge, that I don't think that would be effective at all for companies similarly situated to us, because that's one of the reasons we are a non-registrant member of a DCM is because of our size, because we want to take advantage of the economies of scale of discounted trading rates. So all the ones that are having this problem would probably be in your size. So I don't think that would not be an effective way to distinguish among companies like us.
Yeah, I would tend to agree as well. I mean, for a CTA, you could be have $1 trillion in assets under management, but if you're doing $10 million worth of derivatives trades, that doesn't mean your call should be recorded and someone else shouldn't. So I don't really know if you could really get the proper size metric to exclude who you should.
Well, thank you, everyone. I think as the chairman mentioned at the beginning, everyone has the opportunity to comment on the topics that were covered today within the next 2 weeks. You can do that through our website. I believe there's a break now between this and the next panel. Thanks, everyone.
We'll now start the second session of today's roundtable, which is the regulatory treatment of forward contracts with embedded volumetric optionality. My name is Carlene Kim, a Deputy General Counsel in the Office of General Counsel, and I'm joined on the panel today by my colleague in OGC, David Aaron, and my colleague in the Division of Market Oversight, J.P. Rothenberg. Any views that we may express today are solely our own, not those of any division or office of the CFTC or any commissioner or the Commission. In the month leading up to and following the adoption of the 7-part test, the staff met and discussed with market participants about the various interpretive and implementation issues that they face when transacting in certain contracts with embedded volumetric optionality. The purpose of today's session is to build on that dialogue so that we can consider the relevant issues in a meaningful and thoughtful way. To set the background for the discussion, David will provide a broad overview, and then we'll go around the room and introduce the guest. David?
Thanks, Carlene. I just want to give a little background on how we got where we are today. So in 2012, the Commission and the SEC jointly adopted the final swap definition. The adopting release reaffirmed that, quote, commodity options are swaps under the statutory swap definition, unquote, but it also provided an interpretation that a contract with embedded volumetric optionality satisfies the forward exclusion if it satisfies each prong of a 7-part test, and it stated that if it fails the test, it still might be a forward under a facts and circumstances analysis. In the adopting release, the Commission solicited comment on the 7-part test. Though some commenters supported the test and/or some of its elements, many suggested changes. Market participants raised questions regarding how to categorize contracts with embedded volumetric optionality and how to apply the adopting release's guidance regarding the test. There were many questions on the 7th prong in particular. Today, we want to hear your current views and concerns on these topics to assist us in determining the latest state of play of these issues and how best to address them. In this regard, we note that the comments received in response to the adopting release were received after the trade option exemption, but before DMO issued letter 13-08 providing further relief. So we'd like to hear the extent to which that addressed industry concerns. And now we'd like to turn to the panelists for you to read your opening statements, and then after that we've got some questions and we can have a little back and forth, and if there's more time you could just address whatever you want to. So we'll start over here with Jim.
Thank you, David, Carlene. I'm Jim Allison with ConocoPhillips. I'm appearing today on behalf of the Natural Gas Supply Association, and I've been actively involved in this issue since the beginning. The industry, as David noted, remarked on concerns about the 7-part test as soon as we saw it. And we were among those who filed comments on it. I will say that the problems we noted in our comments as potential problems we now know to be real problems. So it's no longer a hypothetical. The first one I would highlight is the problem with parts 4 and 5 of the test. A strict reading of the language in 4 and 5 works for calls but does not work for puts. There is nothing in the rule that explicitly says that puts are excluded, and there are other aspects of the rule that appear to imply puts. So we have taken the view that it is a drafting error, not a policy decision. If it is a policy decision, then I think it would need to have substantially more backing than there is. Assuming it's a drafting issue, there is some language that we can provide that I think would probably fix it. As with other things, first choice would be to go back and redo the rule, assuming that is not practical in a time frame that's important to us, because this is a real problem right now, so we need a solution soon. Interpretive guidance is probably something that would be very helpful, but that assumes the interpretive guidance is actually definitive and reliable. Guidance that we can't rely upon is not actually useful. So the fix for puts would need to recognize that each party intends to satisfy its delivery obligations if the option is exercised, and the respective delivery obligations are consistent with the character of the option as a put or a call. The problem with parts 4 and 5 as it now stands again is that it works for calls but not for puts. More significantly, of course, as David indicated, is the problems with part 7 of the test. Within the industry, we don't see how Part 7 has any bearing on the statutory test for excluding a contract from the definition of swap. So again, in an ideal world, Part 7 simply would not exist. In the real world, however, it does exist. It creates real, not merely hypothetical problems, and we need definitive, reliable solutions. And again, first choice would be to have a new rule. Second choice is reliable interpretive guidance. And it needs to clarify what's going on and how we get these problems out. Again, we have language to propose. I don't know that everybody in the industry agrees that the language is sufficient because, again, first choice is a new rule. But I think the language would at least be helpful. I'll talk about that more in a little bit. Let me talk a bit more specifically about the problems that we're actually seeing in reality. There's disagreement about how to apply the test. The disagreement includes disagreements with smaller companies, and you might expect that because you might expect smaller companies to have been less diligent in following the evolution of Dodd-Frank in the legislative and regulatory framework. But we also see disagreements with the largest, most sophisticated counterparties. So the disagreement, the confusion is not limited to merely those companies who were not following it as diligently. This is a deep-seated disagreement. We do, in fact, at the moment, have what might be regarded as a workaround. We have agreed to disagree, with the ramification that one party may report the transaction on Form TO and the other party not report the transaction on Form TO, because the two parties have taken different interpretations of the status of the contract. If you're happy with that inconsistent approach, you might regard that as a workaround that will survive. I will note, however, that once we get to a position limit world, if trade options are in scope for position limits, that agree to disagree approach no longer works at all. And there is a greater concern. In some request for proposal, where the requested contract includes volumetric optionality, we have seen the requesting party ask of respondents whether the respondent views the contract as a trade option, and if so, whether the respondent will take on the reporting obligation. When a respondent sees that, a respondent does not know how saying, yes, we think this is a trade option, will affect the probability of success on that RFP. A company that takes a conservative view of these contracts might have some concern that that conservative view puts it at a competitive disadvantage versus respondents that take a more aggressive view. Now, I do not mean to cast aspersions on anybody in the industry. I do not know how other companies are interpreting the provision when they are responding to these requests. But any respondent looking at the RFP, seeing that question, has to wonder, has to be concerned how the answer will affect the probability of winning. And that concern is a burden that no company should have to bear in dealing with regulations. The language that I would propose in interpretive guidance on addressing the problem would have, I think, three elements to it. First, that the optionality, well, and again, this is assuming that parts 1 through 6 have been satisfied, and that assumes in turn that parts 4 and 5 have been corrected. But assuming all of that, the optionality, whether a put or a call, exists to meet the commercial production, consumption, or merchandising, which is to say the entire value chain, requirements of the option owner's business, where those requirements can reasonably be affected by supply or demand conditions, regardless of whether the option owner has arranged for multiple alternatives to address these requirements, and including cases where business judgment is exercised in selecting among alternatives where the value is driven primarily by external factors. The concern being that it is quite rational for a company to arrange multiple ways to address problems. Depending on the nature of the problem, you may need a different supplier or a different delivery path to address the needs. And come the day the problem arises, you need to make a rational choice among the alternatives you've created. And the prudent policy of creating multiple alternatives and of choosing rationally among them ought not to in any way disqualify a physical contract from being treated as a physical contract. And let me stop there. I could continue much longer, as you know, David, but let me give my co-panelists a chance to talk.
Hello, I'm Jerry Jeske, Chief Compliance Counsel for Mercuria. Many of the comments Jim just stated, we certainly concur with, but to try to expedite matters a bit here, focusing on a few things that are particularly problematic. Prong 7 of the 7-part test, the language factors outside the control of the parties, I think is incredibly ambiguous and really creates confusion in the industry. Jim also alluded to the agreement to disagree. I believe that's the genesis of the problem. That language needs to either be clarified or otherwise amended. I would also concur that the rule itself could use a revamp. Another practical consideration that we're hopeful the Commission might take under advisement and actually look at more deeply, because it seems like this concept of gross notional applied to trade options is very misplaced. I'll use the example of a heat rate option. There's the Form TO that is required to be submitted to the Commission, and then there's the 1 billion gross notional email that must be sent. or receive the punitive Part 45 reporting. So folks want to be diligent about how they calculate, but it's a bit of an impossibility when it comes to heat rate options. Some folks might not be familiar with them, but a simple analysis, the numerator of the power of price times the megawatt hours divided by the gas price creates a grossly overstated number that should not be included in the analysis. If folks understand what a heat rate option is, basically trying to determine the power of price versus the power of gas, the price of gas. But when you introduce the concept of quantity into that equation, you get a skewed result. So what are you left with to decide as a conservative party to report, but an overstated gross notional number? So if there's consistent overstating on the part of the folks that are filling out Form TO and submitting it, I question what value is that data to the commission or to anybody. Moreover, you have this inconsistency existing throughout the industry, and really a problem, I think, when it comes to the concept of agreeing to disagree. You're going to have parties who just won't calculate it the same. Jim also touched on position limits. We certainly hope that trade options are exempt from position limits. That would be the logical, smart thing to do, because it's an impossibility to bucket trade options together with swaps, together with futures, and come out with something that is manageable. Last, I would say that we're hopeful that the commission does pay attention to this in a real-time fashion, also, as Jim has mentioned, and I'll turn it over to Todd.
Thank you. Todd Kemp with the National Grain and Feed Association. As I mentioned earlier, our member firms include about 1,000 companies nationwide, grain elevators, feed manufacturers, processors. Volumetric optionality is important to our industry in the context of cash forward contracting. I don't have a prepared statement for you, but I'll look forward to participating in the Q&A with some more detail.
My name is Ryan Joseph, and I work for the Bonneville Power Administration, which is a federal power marketing agency within the U.S. Department of Energy, created by Congress in 1937 to basically market power at cost from federally owned facilities to about 142 not-for-profit electric utilities. I, too, haven't really prepared many remarks, other to say that when Dodd-Frank was being sort of run its course, we had focused primarily on the swaps part of the legislation and really didn't pay due course to options. And once we started looking into it, we realized we had a slew of contracts that had immense volumetric optionality. And given our statutory nature and our requirements, we realized that we probably should have paid a little more attention to the rulemaking around that and probably spend 99% of the time in providing guidance to our trade floor, mostly on options and volumetric optionality. Facts and circumstance, generally causes us to err on the side of caution, and when in doubt, look at things as a trade option versus using the forward contract exclusion for a particular transaction. So to the extent trade options become part of position limits, potentially erring on the side of caution may ultimately cause us and entities we do business with more issues than they currently do.
Thank you for the opportunity to meet today. My name is Eric Perry. I'm with the Schooler Company in Overland Park, Kansas. We are a cash commodity merchant in the agricultural space. And while this probably does not touch us to the extent our brethren in the energy field, it does in the energy field, as Todd pointed out, it does impact our forward cash contracting that we do. We lean towards erring on the side of the cash exclusion in those contracts. So if we are going to evaluate them as trade options, we generally can satisfy all 7 parts of the 7-part test. But I would echo Jerry's points that the ambiguity in prong 7 could be left open to interpretation. And relative to position limit, that's probably where our bigger concern is, in that we do view those cash contracts with volumetric optionality under the cash exclusion if trade options get rolled up into position limits, we will have to figure out how to isolate that, report that with position limits. And that's not actually a position that we have. We deal with those positions as they come up and roll into our derivatives book as a long or short futures position. But it will be a change of course for us to have to view those in respect of the position limit roll up.
Good morning. My name is Dave Perlman. I'm here today on behalf of the Coalition of Physical Energy Companies, as well as a number of other physical energy end users. My clients I'm from the law firm of Bracewell and Giuliani, and my clients are generally hedgers. They're a great variety of energy companies, from retail marketers to large integrated oil companies to E&P companies to electric generators. And while they have a lot of variety of business models, there's one thing that they can all agree on. They can't interpret the 7-part test in a way that they can consistently understand it. And as Jim mentioned earlier, and I'd like to note my agreement with Jim's proposals and comments, the mere fact that we run into a lot of issues and disagreements on whether a transaction is a trade option among people addressing these issues in good faith, I think is very real-world evidence of, as Jim indicated, the concerns that we thought were out there have manifested themselves. Because when we had the issue leading up to the no action letter, where we were all thinking about what are we going to do when we have to report this, we tried as an industry, energy industry, to sort of coalesce around different ways we could deal with it. And the no action letter put us in a position where we could agree to disagree. Had we not had that situation, I think we would have had a much more fractious set of issues that we'd have to deal with. Now, whether that's a meaningful way to deal with things, where you have Form TO, where some people include it, some people don't, is a good outcome. I'll leave that for you to decide. But the bottom line is that we really can't meaningfully operationalize, this is my word, the 7th prong. We can't make it work in a way that we can make clear to our clients. And in my client's case, we have a lot of clients who are not really sophisticated in the CFTC world. They're busy doing what they do in their physical business, and they're very good at it. So we've tried to get things for them that are useful in sort of in a bite-sized desk type of operationalized set of rules. And when it comes to the 7th prong, it's just not something we can do. So what we would like to see happen, and again, since the acting chairman's here, I'm going to be redundant and repeat some of the things that Jim said. I'd like to see you act in a prompt fashion, maybe with a long-term view of fixing this on, you have a record that you had comments filed, as David mentioned, you have other ways to deal with it in a longer-term way. But we need some relief in the short term. And while we would prefer to have the whole thing revamped or the 7th prong repealed, that would be sort of the perfect outcome. In the meantime, we think and would hope that we could get some clarification around what the 7th prong means. And if you'll indulge me, I'm going to sort of paraphrase what Jim said. Because the 7th prong, as we understand it, is an attempt to say that the parties are engaged in something that is in conjunction with their business. They're actually undertaking a supply need or a merchandising need in coordination with their business, and they've put the optionality in their contract so they can take action in the event of circumstances in a timely way that they have provided an opportunity to address. It's not so they can monetize this and make a physical contract into a financial contract. That's not what we're talking about here. And if that's your concern, I'm hopeful that this language will help you. And it's where the optionality, inclusive of puts and calls, is intended to meet the commercial production, consumption, or merchandising requirements of the option owner's business. And so we're talking about physical commercial businesses, which can be reasonably affected by supply and demand, this sort of outside the control of the parties type idea. But that gives a little more granularity to what outside control means. And it's regardless of whether the option owner has arranged for multiple alternatives to address the requirements, because one of the things that we had understood was if the option owner had multiple alternatives and they may be making a decision, let's just say, in this case, based upon the best price, that would be based upon economic factors, not on factors beyond their control. And frankly, it is rational and common that parties will have multiple supply sources for reasons that have to do with the things Jim said, including reliability of supplier, certain other characteristics of the transaction that would make it more suited to their needs at that time. And of course, price is important. But if you need something for your business and you have something where price is all that matters, you might end up not getting supply. So you need to be redundant and careful to make sure that you get your commercial needs met. And finally, and this is related, including cases where business judgment is exercised and choosing among those alternatives, including qualitative factors. As we're saying is I might have multiple alternatives. One is better than the other for my needs today. One is better than the other for my needs tomorrow. I'm making a prudent business decision given the factors and alternatives I have before me. The other two items that I think I'd like to address given the limited time is first, there is some ambiguity in our minds too around what optionality means. The Commission has precedent on the definition of an option, and there was some language in the order about some Commission precedent, and we think it may be useful, and we could follow up with comments on this to get a little more clarity and granularity on what optionality in these contracts means. Does it need to meet the test of what the Commission has said an option is? So is it an option embedded in a forward contract, as you've stated, or is it a forward contract merely with different quantity opportunities in it? And we think maybe the former is the right answer. And second, the position limits issue is a real material and really, really conceivably problematic issue. We are in the business, again, of meeting our physical needs of our businesses, and we are undertaking something that is, in my mind, very hard if you look at the definition of a bona fide hedge that the Commission has proposed in the position limits rule to meet the test of a bona fide hedge. It isn't hedging a cash contract that has price risk. It is the cash contract. You could maybe hedge your trade option, but your trade option is not something that you speculate in. It's not the sort of thing that has price discovery impacts. It's not the sort of thing that can be made sensibly or easily, as Jerry was saying, into futures equivalents. So we're hopeful that you'll understand, and when you get to that aspect of things, not included in position limits. So as Jim also indicated, we'd be happy to suggest language to you in the comment period subsequent to this conference, and be happy to answer any questions that you have.
Good morning. My name is Paul Hughes. I'm the Risk Control Manager for Southern Company, and I'm here on behalf of EEI, and y'all know EEI is the investor, represents all the investor-owned utilities in the U.S. I wanted to maybe give a different perspective from the electric utilities side, but generally fuel diversity is a very important component of electric reliability, and at Southern we've developed a diverse portfolio of generation resources. To meet our customers' anticipated energy needs, we build generation resources ourselves, and we also purchase generation capacity from third parties. When the time comes to employ this generation, the industry uses complex dispatch models that analyze a combination of operational, locational, and market factors to determine what the resource mix should be. And the goal is for our customers to have both the low prices possible while also maintaining reliability. So inherently, we build in a lot of redundancy to our processes. Due to the current lack of clarity in the rule, what we've found is that counterparties to a transaction may view the same transaction differently, with some viewing it as a forward, some viewing it as a trade option, and some viewing it as a straight-up plain vanilla swap. And the willingness of the parties to agree and classify the transaction as a trade option is further complicated by the inclusion of the trade option in the new position limits rule that's upcoming. Now, at Southern Company, we have gone to great lengths to comply with Dodd-Frank. We've even developed software to help us evaluate all these contracts and do they pass all the factors of the various tests. And the result of that process and taking all these contracts through those tests is we think there is a conflict between Section 1A47 of the Commodity Exchange Act and the seventh factor of the volumetric optionality test. The Dodd-Frank Act states that the term swap does not include any sale of a non-financial commodity or security for deferred shipment or delivery so long as the transaction is intended to be physically settled. However, the application of the seventh factor by Southern Company, and we readily admit we take a very conservative view of this, has resulted in the inclusion of several contracts that can really only be settled one way physically. Yet in the spirit of the rules and the language that's there, we really think that perhaps that's not how they should be, not how they should be graded. So accordingly, there's a conflict between the results what we're getting from the seventh factor test and what Congress intended. This may be due to the fact that the seventh factor has a misplaced focus on the option exercise. Because at first glance, the concept of excluding optionality based on primarily physical factors outside of our control seems reasonable, particularly when considering the impact weather has on demand. However, this is problematic for the electric industry as it oversimplifies industry practice, because dispatch models take into account a multitude of factors when determining the resource utilization. Attempting to determine the primary cause of exercise at some point in the future is impossible, even if it were a factor that is under our control. We just don't know at the time that we have to make that determination. We think there's several solutions available to the Commission, and we think simply, one, remove or replace the seventh factor is one way. The other way may be to change the focus of the seventh factor from the exercise of the option to the commercial intent of the agreement. I would echo the same sentiments I think we've heard from Jim and David and others about perhaps some ways we could tweak that language to recognize that kind of physical operational intent that does exist and is not, we have activity that does not respond to price signals. When you value an option, and typically you value an option, you look at, say, well, you're going to assume based on the economic signals that option is always going to be exercised. Well, that's not the case in our industry. We have physical constraints that may prevent us from exercising that option. We can't simply take one element and divide it and say, well, today it's in economics, tomorrow it's operational, the next day it's locational. For us, all of those components are inextricably linked. We can't just pull them apart. And that's, I think, what we're dealing with in trying to make determinations. And that's, I think, what creates problems in the ambiguity between our commercial counterparties and leads to some of these disagreements, may be strong words, but longer conversations. I would say it's slowed down the commercial process a bit. But that being said, I think there's several venues that the Commission could take, whether it's a change in the rule, whether it's something like the OGC did on our infamous however clause last year. I think there's several ways to get there. And we welcome really any of those. And so I appreciate the opportunity to come talk and discuss this.
Good morning. My name is Tom Nelly. I'm the Chief Compliance Officer for BP's marketing and trading businesses in North America. And as such, I'm also the Chief Compliance Officer for BP Energy Company, a provisionally registered swap dealer. I don't have any prepared statements, but I do echo what my co-panelists have said. We do think that the seventh prong of the test needs to be redone so that it is very clear. We have seen instances where we do disagree with parties on whether things are trade options or not, and a lot of times there is a agree to disagree. And we're in a kind of a unique perspective than I think others on the panel. Being a swap dealer, we have a higher obligation under real-time reporting that we have to get these reported to the SDRs within 2 hours now. And that can, if it's vague, it generally means that marketers are having to come to compliance, to legal, to get definitions on or confirmation on whether things are trade options or not. We can't necessarily give them just foolproof guidance where they can go out and run their business. If we give them very little and ask them to come back to us, that takes time, it takes effort. And then the other part for a swap dealer is we need to be able to isolate these deals easily in our system to be able to efficiently report them to the SDR. Right now, that's a very manual process, as you can imagine, from having to identify these options as deals are getting done. And since there are no standard format to put these in, a lot of them are submitted manually to the SDRs, which again takes time from the commercial staff, the mid-office staff, all the way back to our confirmation staff to make sure that that happens. And that is quite burdensome. On position limits, I would agree that they shouldn't be included in the position limits. these aren't, I think it was David who said, these aren't instruments that can really be traded in and out of. And a lot of times we are doing these things as a service to our customers who are looking for different ways to get molecules to run their business on stress days. And so if they are included in the position limits, that would cause them to be physical contracts, which if the conditional limit does pan out in the new rules, we may not be able, or a company may not be able to take advantage of that if they've got, the only thing they have sitting on the physical delivery contracts is CTOs, which you can't just go and get out of on an easy basis. There's no standing market for that. So given that, we would prefer that they not be included in the position limits, such that we can focus the position limit activity on the futures and the swaps and the real over-the-counter swaps. Thank you.
Good morning. My name is Wallace Turbeville. I'm from DEMOS, which is a public policy think tank and advocacy organization. And as such, I have different sets of interests than anybody I see around on the table. And I understand your interests. I do. I understand that you don't want to, you want to burden your business as little as possible. And I really appreciate that. But our interests, what we're focused on is the public's interests. And the public's interest as expressed in the Dodd-Frank Act and in the notion of transparency. I don't normally do this, but before I was in the business, such as it is, of thinking and writing about these kinds of issues, I spent well over a decade at in the energy group of a major investment bank, and then later for another 7 years ran an energy derivatives risk business to manage that risk. So I kind of think of these things maybe a little bit differently, and I think part of the problem is almost a fundamental conceptual problem with the discourse. When you say we can't get out of these things, what are these things? I think of these things as if there's a risk package inside a contract that could be hedged in the marketplace, not detached and marketed, which who detaches and markets any derivative? You don't sell a derivative, you cover it. So I think fundamentally, if something can be detached and hedged in the marketplace, it is a derivative. I think that if there's a sophisticated party on the other side of the transaction, they view it as a derivative. They'll put it in their risk book as a derivative. They'll measure it as a derivative. So the going in question of optionality is one where is this the kind of thing that could be sui generis, hedged, and addressed in the marketplace. I understand that these things aren't intended on your part, for most of the people who've spoken so far, to monetize or to speculate, but then neither is a conventional bilateral swap with an end user. I don't think it's a question of whether the thing is intended to be monetized. If it addresses a legitimate risk in your business, that may have some pertinence with regard to position limits. I understand that too, but that doesn't change the fact that just can't be ignored, that this is indeed an option. Now, also having had the experiences I've had, I understand further that when some folks in the marketplace who are very sophisticated do a contract like this with an embedded option, the pricing of that option is something to feast on, because the fact of the matter is that the complexity associated with embedding an option in a physical contract is something that is the opposite of transparency. It's the ability to obscure, because the quantitative analytics associated with it can create a situation where pricing is very difficult to understand. So in one sense, I think there's a value to the market in terms of actually getting transparency and getting reporting and seeing what this option is really worth. I think that's actually an advantage that is ignored, because I understand people want to do things the way they do things and have done things in the past. So that's where I'm coming from and where I'm going to be coming from in the discussion. I do want to go back to the heat rate question, the heat rate option question. And yes, sir. Hi. The heat rate option question is one that seems fairly straightforward. Heat rate is nothing but a valuation of the conversion from gas to electricity, and there's a volumetric value associated with that, but that is to me it's no different from an option or a swap in terms of its notional value, as long as the value you put in is the right value to start with, and quantity is right quantity. So maybe that can be discussed. Thank you.
Hello. Okay. I'm Chuck Syria from Hess Corporation. I've been involved in trading in physical commodities since, I believe, October of 1998, from both the perspective of the provision of the commodity to the commercial and industrial users, who potentially end up to people such as this building and the lights on in this room now. So I've also been exposed to the trading side of things, the structured products and everything else. And by the way, as a housekeeping, I'm here on behalf of Commodity Markets Council, and what I'm saying are my own thoughts and not to be attributed to anybody else. Okay, so I just want to get that out. But getting back to my opening comments, I don't know if they're prepared or not. I have kind of notes all over the place here, but I agree with all of the points. I'm not sure I understand a lot of what Wallace is saying, so I don't know if I agree with Wallace, but I know I agree with my other panelists to the extent that they've gotten into the weeds. I agree with those, and we've seen some language, and we're willing to work with you, David and Carleen, to to maybe improve upon the seventh prong as at least an intermediate step. But if I could, I'd like to just ascend a little bit and maybe go 20, 30,000 feet up, and actually commend everybody and commend the commission for being as vigilant as you have been in trying to distinguish a physical from a financial. The reason that I offered to join this panel is because I actually think that's the single most important topic in all of Dodd-Frank, okay? Because everything, the waterfall just rushes after that determination is made. And so getting this correct, I think, is the single most important thing that we all can do. And I appreciate the effort from the commission and even Congress, okay? Because as other panelists have said, let's focus on the fact that Congress expressly excluded transactions that are intended to be physically settled at the time of the transaction. That's an express exclusion, and I think that's got a lot of significance, and we should never water down that significance, okay? So correctly distinguishing between what's physically settled and what's financially settled, or a financial instrument, so to speak, is absolutely critical to getting this whole thing right, okay? And just as, again, maybe I'll go another 5,000 feet up and say that it's significant not only within the U.S., it's also significant worldwide within the G20. And Mark, I know that you've been outreaching a lot over the last few months. Thank you for that. But the EU defines financial instrument, which is, I think, probably close to what we're calling a swap here, and they're thereby mandating clearing They include physically settled contracts that are traded electronically on a multilateral platform, and that's different than what we're doing here. These kinds of things have got to be ironed out, and we have to have a clear division recognizing the value of a physically settled contract versus a financially settled or financial instrument. So this work is really important, okay? Getting back to the provision of, in my case, energy, okay, or molecules. I mean, they're there. We are providing an essential resource and commodity to society, okay? And I'm not going to get too dramatic or too over the top here, but that's really what we're talking about. Again, like the contract to supply, to power the lights that we're all enjoying now, okay? If we decide to switch off the lights because we're going to go on break or something, we've turned off the power. I mean, that's the kind of volumetric variability, if you want to use the word variability instead of optionality, okay, that we're talking about when you deliver a commodity, okay? And it's the same with oil and whatever the commodity is from an energy standpoint. I can't speak for grains or metals, okay? And so we've been doing this for decades with much success. We are commercial market participants. We've established the ability to do that, and society actually appreciates that. And these volumetric optionalities, as they're called, that are embedded into these contracts, developed as a consequence of the market trying to sharpen its efficiencies, so that only the amount of molecules that need to be dispensed to satisfy demand are dispensed, and no more is wasted. So there's a lot of public policy behind efficiency and encouraging the market to continue to develop its efficient means, okay? So getting back to what I said earlier, now, by the way, I think I've come down about 20,000 feet, okay? So getting back to what I said earlier, we can't allow ourselves to be persuaded to think that these are speculative financial instruments. We're talking about the basic commodity contracts here. And when you deliver a commodity, you're going to have variability in volume. That's just how it is. And so I think I've talked for a while, and I'm not going to talk anymore. The only thing I want to end with is, and David has said it, and a lot of people have said it, what we need something that's workable in the moment when these transactions are executed at the time of the transaction. Something that the parties all agree either is a forward contract exclusion, or is a commodity trade option, or is a swap. And, you know, getting back to transparency, Wallace, I do agree with you on the value of transparency. When you sit back now and look at what do we have in the SDRs and what do we have in Form TO reporting that we've all just gone through, we have a lot of probably inconsistencies, like everybody is saying here, and that devalues the reporting and transparency. And worst case is it actually leads us to a path of thinking we have reliable information when we really don't. So it's that false sense of security that always like nags at me, okay? And so I think I'll leave my opening comments here. Thank you.
My name is Patty Dondonville. I'm a partner at Reed Smith, and I'm here at the request of the Not-for-Profit Electric Coalition, which is the coalition of rural electric cooperatives and municipals, government-owned utilities that are the quintessential, if you will, end users in the marketplace. Their job is to deliver power 24/7, 365 to their clients, their customers. They have, as Chuck and David said, for years, distinguished very clearly between contracts where they intend to physically settle, which is 99% of what they do, and financial instruments that they use solely to hedge. So they don't, as the professor was saying, speculatively trade. They don't trade in metals or crude oil or financial commodities of any sort in a trading sense. They use natural gas, electricity, and other energy-related commodities and commodity swaps to hedge their commercial risk of operations. To comment on the volumetric optionality, I really need to go back to Chuck's 30,000 feet, because all this generates from interpretation that David Aaron cited at the very beginning, which was the Commission's interpretation that the statute before it, 72121 of the Dodd-Frank Act, required it to see all commodity options as swaps. We're not in an exercise to determine whether things fit in one of three categories here. There are two categories. Is it a swap or is it not a swap? That's the question that all my clients are asking me on a day-to-day basis. Because if it's a swap, it has consequences. You have to report it within 2 business hours, within 48 business hours if you're end user to end user. So swaps have consequences. If I respond to them with a series of interpretations, and they're not rules, they're interpretations of the CFTC. They're not joint rules with the SEC. Footnote 205 essentially says the CFTC takes no part in this section of the interpretations in the products definition release. So there are interpretations out there. And the energy industry, as Jim said, has requested since they were published that they be withdrawn. My group has on file with the CFTC a request for reconsideration of that basic question. Are all commodity options, even if the parties intend to be physically settled, swaps? We think the answer is no. And we've asked the CFTC to go back and reconsider that legal decision, and we've not heard a response. So I think I agree with what Jim said, what David said, what Paul said. The energy industry is looking to the Commission. We're very appreciative of this dialogue. We've provided the CFTC with reams and reams of input on how these tests, these interpretations don't work in our industry. And we're asking the CFTC first, address the motion for reconsideration. Let us brief it. Let's talk about that conclusion. Beyond that, let's treat the symptoms of the underlying problem. Please withdraw the 7-part test, the test that's the interpretation that's out there with respect to physical commodity transactions. You asked 7 questions, we answer. We would like, in most instances, for you to withdraw that, but if not, let us know what you don't understand about the comments that we've submitted about how they don't work in our industry. Let's open the dialogues. Let's see if there is a way those interpretations can be fixed so that the CFTC doesn't see what I call option ghosts. Because when you're seeing those option ghosts in our 200-page contracts, you must be seeing swaps, because otherwise we wouldn't be here. And if you're seeing swaps, then those should be reported. But the reason you're having such problems with your swap reporting is because there is this tremendous disagreement as to what's a swap and what's not a swap. And people are not taking a conservative view or an aggressive view. I have clients all along the range of that parameter that are taking different views of the same transactions, and then they're trying to, in some cases, take a conservative view and slam those puppies in to the very narrow descriptive data elements for swap reporting. And they're doing that in different ways. We talked about not having trade options be under position limits. Well, that's because they're not swaps. And what position limits are intended to do is test financially settled contracts, not physically settled contracts. So as I say, it all goes back to the ultimate question: how can we engage with the commission in a constructive dialogue about changing the underlying interpretation of 1A47? And if not, how can we treat each and every one of the symptoms where that will continue to pop up in your rulemakings, in the Federal Reserve's rulemakings once they come forward with revised rules on margin and capital? Because these things are going to come up time and again unless we fix the underlying question of what's a swap and what's not a swap.
Susan Burgles, I represent energy utility clients, and today I'm here on behalf of the American Gas Association, and I'd just like to start out, I'll be brief going last, but just thank you to Chairman and staff for holding this very important conference on this very important topic. I'm looking forward to having more in-depth discussions along the lines of what folks have been talking about already today. Briefly, the American Gas Association members are regulated energy utilities that deliver natural gas to millions of residential, commercial, industrial customers throughout the United States. These entities stand ready to meet their customers' gas needs at rates, terms, and conditions that are subject to state regulatory authorities. Again, these entities are regulated entities. They're used to being regulated. They understand regulation. They understand compliance. What we have been talking about around the table here is entities need to have more clarity to understand what is a swap and what they should be complying with. Part of how gas utilities meet their obligations to provide gas to their customers is they develop seasonal plans, as we discussed before, including a portfolio of various supply sources, storage, and transportation. Included in these are the non-financial physical commodity contracts. Because meeting customer needs some is impacted by weather, which cannot be accurately predicted or forecast. A certain amount of planning goes into entering into contracts with volumetric optionality. This is done to cover your changes in your customer need and demand fluctuations. It is also the intent when we enter into these contracts that what you're getting is the ability to call on firm physical supply. The intent is that the product is going to show up upon request. So physical delivery is the underlying intent, and these transactions are viewed by the gas utilities as just common and necessary tools as part of their ability to meet the reliable and cost-efficient needs of their customers. AGA does not believe that Congress or the Commission intended to include peaking or swing contracts under the Dodd-Frank regulations as swaps. We believe that they should be excluded from the regulation as a swap, but under the 7-factor test, as we have been discussing today, there remains regulatory uncertainty. In order to alleviate that regulatory uncertainty, we propose CFTC Commission action to address the comments that have been filed in the open docket, the further definition of swap comments filed October 12th, 2012. Included in that, I would echo some of the discussion that has gone on today, which is with respect to the 7th factor, the proper focus, we believe, and it's in AGA's comments as well, should be on whether or not the transaction satisfies the 7th factor at the time the transaction is entered into. Have there been compliance challenges? Yes, I'll be happy to discuss those further in detail according to your questions today. But others have already discussed there's been disagreement, there's been confusion in the marketplace. People are reporting on Form TO probably different. Some are classifying things as a trade option. Some folks may be considering them as exempt forward. That's why, again, we believe it's critical to have regulatory certainty. Briefly, have there been, one of AGA's concerns has been impacts on the physical natural gas marketplace. There has been impact on market liquidity, innovation. AGA members are seeing a decrease in the kinds of commercial offerings counterparties are willing to make, a decrease in the number of commercial counterparties willing to enter into these flexible transactions, which gas utilities rely on to serve the needs of their customers. Again, this is impacting the robust participation and the innovation that the industry has had for the last 20 years. That's also resulted in billions of dollars of savings to customers. So ultimately, you know, the ultimate impact, if you need any more reason to do something about this, is definitely that the impact is ultimately passed through to customers. Gas utilities, any increased costs in procurement of gas supplies are passed through to their customers at cost. As a result, you know, increased gas costs will ultimately lead to higher natural gas prices paid by the American energy customers. So again, we believe it's critically important for the Commission to provide clarification in the form of a final rule based on the comments and the clarifications requested in the docket. We believe that part of that clarification should include the focus on the intent of the transaction when the transaction is entered into. And briefly, I will just say the AGA did file comments in February of this year on position limits, and consistent with folks that around this table has taken the position that trade options should not be subject to position limits. Thank you for the opportunity to speak at this roundtable.
Susan, can I ask you a quick
Sure.
question? So help me understand a little bit better, if you could, the practical effect of when you have two parties that are considering entering into some kind of an agreement, but they don't agree as to what kind of a contract it is, whether it's a forward or a trade option. So other than, because of the disagreement, one party deciding they might not want to enter into the contract, what are some other things we should be mindful of, or what other kind of problems does that create?
Well, I think that this first round of reporting on Form TO happened and people were looking at transactions that they'd already entered into. So I think folks were more concerned about reporting for their own self and their own regulatory compliance, so they're making the best decisions they can, and probably out of an abundance of caution due to maybe a reluctance to have it fall within the 7-factor test, they're going to report maybe the transaction as a trade option. Going forward, I know some of my clients have not negotiated some of these transactions yet that will occur in the summer. They have already informed me that two of the main entities that they have done transactions for with flexible delivery terms in the past have decided to exit the natural gas business. So that's going to be an impact. So a lot of the new discussions, at least to my knowledge, have not taken place. I don't know if other people around the table.
Probably because I think Paul had mentioned that a lot of times you're having longer conversations that maybe end up being resolved. So at the beginning of the conversation, maybe there's confusion, but at the end of it, perhaps there's not. So I just want to get a sense of that, and whether there might be other practical problems being created by all
Sure,
this.
I think Susan alluded to it, but I think it does extend the commercial transaction time, because there is this discussion of, what is this a trade option or not a trade option? Is it excluded forward? Is it not? And those parties, I think the way the rules are set up, legitimately can have a different view of that, because I think I don't know if we mentioned it or not, anybody here mentioned it or not, but there's kind of this underlying question: can I rely on my counterparty's rep, on their representation? So if they say, I'm only going to use this commodity for something outside of my control, okay, well, can I just accept that rep and move on? have to be very careful before I answer. I'm not an attorney. I'm just trying to implement the rules. But I can tell you my attorneys come back and say, well, wait a minute. Are we in essence kind of turning over our compliance to a counterparty? Because what if there is some type of contract and insert whatever commodity you want to, but there's flexible delivery options, and let's say they can take from, I'm just going to say 0 to 500 MMBTUs, megawatts, whatever you want to put in there. And the first let's say it's a 10-year agreement, long-term agreement. So those first 2 days, they take lots and lots and lots of volume. Day 3, day 4, through the rest of the term, let's say they don't take anything else. Am I now in an awkward situation where I go, wait, you told me this was only going to be for regulatory reasons. I know it was really hot outside, but nobody ever called on this. And it puts me in a very awkward situation. I think you find reluctance on both parties. I don't think it's just ours, but I think we've kind of seen and heard that. And I think there is kind of this inherent reluctance. I know we kind of agree to disagree. I think that was couched either in this discussion or maybe the one before, that agree to disagree as a workaround. It doesn't feel good, though. All right? I mean, so you agree to disagree, but you know that, if, for example, I'm going to classify something as a trade option and the other party says, no, that's not a trade option, well, I'm going to include that in my Form TO. And that other party's going, so there's this agreement or contract out there that's being reported on somebody else's regulatory report. If they come back, somebody wants to look at that in the detail. Why are you not there? And I think there's just a natural reluctance when parties can't agree to kind of absolve themselves of that, and it does slow down the commercial process.
Can I add to that? Because I have multiple clients who have addressed this all kinds of different ways, and it goes to some degree to what Patty said. Some of them are not sophisticated in this area. They're very sophisticated at their business, and they've decided we don't want any swaps. We're not going to report anything. We don't want any swaps. That's our policy. So they had contracts of volumetric optionality until this rule came out. Now they don't have them at all. They won't do them. So they're significant natural gas entities. They do not do contracts of volumetric optionality. They can do much more logistically difficult transactions where they can enter into multiple individual contracts that have a quantity. So instead of having a contract that had optionality in it where it could be moved around, they have to instead enter into daily contracts or hourly contracts for quantities, which is much more burdensome but gets to the same outcome. Maybe that's what you meant by a workaround. The other thing that I mentioned was that when we came towards April of 2013 and we were looking at the need to report, it was obvious that the parties in the marketplace were not going to be able to agree. And as Paul said, there's discomfort on the fact that we can't. We've run into parties that want to put reps in agreements. This is one of the issues with reps, where all the transactions that we will do today for the rest of time will have the following characteristics. These are contracts we haven't even seen yet. And we see a lot of people trying to put those reps in contracts, which is problematic because the lawyers work on the reps and then the business people do the trades. And maybe there's a discontinuity between the trade that happens 18 months later and the rep that was made. Who knows?
And the operations people are the ones that actually exercise the option at some point when it's below zero across most of the Middle West.
Right. And let me just
go ahead.
The final thing, and I'll turn it over to you, Patty, is that because of the way Form TO works, where you can have individual reports without consensus, you end up with a situation where people have no need to agree. And the freedom to decide what you think is right, in good faith, I'm assuming, and report whatever you want, is really a way that the regulatory requirements of the commission kind of fall by the wayside because nobody ever has to deal with it. We will if we have to deal with position limits. I've gotten more questions than you would suspect where people say, what is the commission's remedial authority and what kind of penalty can I have if I mischaracterize something as a trade option that shouldn't be, or the other way around, because people are concerned that they're making a mistake in calling it a trade option. And I tell them it's $140,000 and they don't like that. I tell them that I think the commission's in a reasonable place and the commission is not going to penalize you. And they say, we are conservative, compliant entities. We want to do it right. Your judgment is appreciated, but that's not the real determinant. It's the commission's decision. So I think you can get a level of, I'll call it false comfort, from the fact that people have not had to agree and they've had these discussions and maybe parted ways at the end. But at the end of the day, from a regulatory perspective and a true compliance perspective, there's really no true consensus or understanding of what the commission is expecting.
I think that if you go from the other direction, clarity is really good. That's an important thing, and I think it's an unfortunate thing if these discussions are going on and people are taking different views. That's not good. But the other way to look at this is they really are options, and that you can't do anything about it. And instead of when I read the rules, it seemed to me that the commission was trying very hard to be as accommodative as possible. But underlying all of that is that these things are really options. And there's a complete. We're not talking about the contract of delivery and the settlement of the delivery of the natural gas or electricity. We're talking about the option that is embedded in it. And if you look at how Goldman Sachs, Morgan Stanley, J.P. Morgan built their businesses around derivatives and physical, especially in businesses like electricity, where the physical is not. It's not like a bushel of corn. The physical in electricity is energized electrons. So there's no bright line distinguishing factor when it comes to what is a swap or an option and what is a physical. Those blend into each other over time financially. But the other way my point being, the other way to address clarity is to actually make it very clear that we recognize that these things are options, which they really are, and then proceed accordingly. And if the fact is that if somebody's doing options and they need to report, okay, they need to report. Somebody has made the decision, Congress, that's overall good for everybody. And I do not believe that the lights are going to go out or natural gas is going to cease flowing if the outcome is that these things are recognized as options when they can be actually hedged in the financial marketplace.
Can I come back, though, and point out that Congress didn't put in place in 2010 something that says options need to be reported. They put in place something that said swaps need to be reported. So again, this traces back to the question of whether if the parties intend physical settlement, which if there's one rep, I think you would agree, David, and all of you would agree, people are perfectly willing to put in their forward contracts, whether or not, is that they intend physical settlement. I've never gotten disagreement about that.
Physical settlement of the physical or physical settlement of the option?
No, physical settlement of the option is precisely the question.
Physical settlement, as the rule says. Physical settlement, not of the option, not a delivery of the option contract, but physical settlement of the delivery of the commodity.
I understand that.
Okay? And there's nothing, absolutely. We're not talking about the delivery of an option contract here. What we're talking about is what needs to be reported and what doesn't need to be reported. And the CFTC is not putting in place options reporting. What this is about is swaps reporting. And the disagreement as to what needs to be reported is that fundamental question. Am I entering into a swap? Because it has consequences if I am. Don't give me an answer that says there's a 7-part test to figure out whether you have an option. That's not the question I asked, say my clients. My clients say, is it a swap or not?
So if I can pick up on that point, Patty. There are some contracts that have variable volume where there is a legitimate question about whether it's an option. And that's on the second page of the questions that were circulated for this panel. For the most part, Wallace, however, the question is not whether there are options. These are options. They are structured as puts or calls. They have a premium associated with them. We invoice for the premium and we expect to get paid. There are provisions that describe how exercise happens. These are options. That's not the question. The question is, are these options intended to be physically settled? Because it is that takes it out of the definition of swap according to the statute. And everything we're talking about here, parts 1 through 6 of the 7-part test, assuming you fix 4 and 5, parts 1 through 6 speak to the question, do the parties intend for this to be physically settled? Part 7, to my mind, doesn't even address that question. And the question it does address, it addresses with such ambiguity that we have all of this confusion. And Mark, I can assure you, the agree to disagree is not a hypothetical, it's real. And that means that there are contracts that we have reported on our Form TO where our counterparty has told us we don't think that is a trade option, we do not intend to report it. Now, I don't know what they actually did. Because as Paul points out, once they know that we intend to report it, that may alter their decision about what they do. But I know that as we were preparing ours, we said, in our opinion, this is a trade option because I cannot prove to myself that Part 7 is satisfied. And I don't really care what rep you're going to give me because unless the contract is such or your regulator is such that your hands are completely tied, we know you to be a business-like counterparty and we expect you to operate in a business-like manner, and that causes you to fail Part 7. So you can give us a rep, we're not going to believe it.
You know, the reason we're all here today is to solve problems, and I just was thinking about, reflecting on your response, Jim, thinking about what David said, and I thought you said that market participants are entering into a number of additional contracts in place of just doing a forward with volumetric optionality. So the question is, like, how practical a solution is that? I mean, obviously it sounds like it's a little bit more difficult because you're entering into a bunch of contracts instead of one. But help us appreciate more just how cumbersome that is. In other words, yeah, people are doing what they need to do, or still able to do what they need to do, perhaps differently and through additional transactions than what was done before. But is that something to what degree do we need to think about that?
The point is that there's a regulatory ambiguity that we think, if it is clarified, would rectify the issue. And absent the clarification, if there's a business decision that's made, we don't want to be reporting anything, we don't want to engage in activities that are going to be CFTC jurisdictional, they can find ways, in this case, around it. But that is less efficient, it's less timely in able to act, it's difficult to do the overriding initial business deal that's the best economically effective business deal, and it requires there to be a real-time interaction that's more robust and has more documentation issues associated with it. Is it impossible to do? No, it's not. Is it a productive use of resources? No, it's not. Does it benefit society to have to go through that? My judgment is no. I want to just say one thing in response to what Wallace said, because I used to be the head of legal for Lehman Brothers commodity business. They're not around anymore. I don't know if you heard about that. But we did a lot of things on Wall Street where we priced options. We understood what we were doing. Everything was directed at monetizing things. They were physical businesses, but they were very much, at the end of the day, they had a physical component, but it was very financial in a lot of ways. That is hugely different than Paul running a power plant to serve Patty's customers and having Patty's load guy call up and say to Paul, look, we lost our peaker unit. We want to increase the dispatch on your power plant because we have the right to ask you for that because we're trying to keep the lights on at our customer's house. That's what we're talking about here. We're not talking about Goldman Sachs doing some kind of financial engineering of an option product. We're talking about, in the main, commercial parties, commercial entities that require optionality in their fundamental arrangements with their counterparties to meet their commercial needs. So I don't quibble with what you're saying in certain circumstances, but I think that limited aspect of things, if you look around the table, you see a lot of entities represented here who are just trying to do their commercial business and also be compliant with what the commission requires.
Think what an odd conversation that would be. My client would have to say to Paul, I want to call on your generation. Paul would have to say back, is the sole reason or the primary reason or the principal reason you are exercising or not exercising the option your demand, or am I the cheapest in your dispatch pile? Because you have choices as to which generation unit you ramp up. And if the answer is you're the cheapest, does he have to say, then I can't acknowledge your exercise? It's at a different point in the commercial relationship that the exercise or non-exercise takes place. It all needs to happen the day the execution of the contract happens, because that's when the question becomes, is it a swap or not a swap? Do I report it? Do I not report it? Does it go in my position limits, intraday position limits, or not?
And if I can come back to David's example. So the counterparties that have stopped doing option contracts and have done all of their business in the daily or hourly markets. The alternative of the daily and hourly market is something that is available to them even if they have negotiated the option. And the choice about whether to go into the daily market or whether to exercise the option is part of the business decision that goes into choosing whether to exercise the option. So it's not as if they've created something new. That exists all the time. So the question then is, well, given that it exists all the time, why did they bother with option contracts in the first place? And there are two reasons. One is certainty of supply, so you know who your supplier is. If you go into the daily market, you have some level of confidence there is going to be a supplier, but you may not know who the supplier is going to be. So by negotiating the option, you've got security of supply. You know who your supplier is. And there is also an element of price protection, because if you are satisfying your variable needs in a daily market or an hourly market, that daily or hourly market presumably has a price that is following the changes in demand. So if you only have access to that high-frequency market, you are going to be bearing all of that shifting in market price through that frequency. Whereas the option, and Wallace talked about the option may also have characteristics that give you some degree of price protection. Now, I'm going to argue that that degree of price protection embedded in the option is not sufficient to make it a financial derivative, because a financial derivative transfers price risk without transferring title to the commodity. But these are options that, yes, may transfer price risk, but they also will, when exercised, to transfer title to the commodity. So they fail the most basic definition of what is a financial derivative. And that's an area where I disagree with Wallace.
Unless there's that cut me off. Unless there is a financial settlement option.
Yeah, but one of the other parts excluded that. So again, Part 7 isn't dealing with the issue of whether you can cash settle this. Part 7 is dealing with something about the intent to exercise.
Yeah, right. That's what I'm saying. But the intent, what I would say is clarity. I'm suggesting a different approach. My point is that what I'm suggesting is clarity, yes, but with a presumption that it's a financial instrument under certain characteristics, and then move on.
But I think we've all already agreed that if cash settlement is an alternative, that it is a financial derivative, and I don't think within the industry there's much argument about that. We're not talking about.
Well, but
we're not talking about.
There are a number of ways to get there with.
I mean, we're talking about instruments that settle physically.
The root of the issue is physical redundancy and physical optimization have some characteristics that look like optionality. But at the end of the day, it's not financial optionality. And I think Wallace would probably agree with that. But at the end of the day, there's not a financial swap instrument that will keep the lights on or deliver gas or get coal somewhere up. And that's what we're kind of going back and forth is physical instruments that we use, physical contracts that we use to meet physical purposes. So that's why we separate the two apart. So we use financial swaps to mitigate and hedge our price risk. We use our physical contracts to mitigate and hedge, if you will, our physical risk, because we cannot just serve one side of that equation. We have to balance it, and we cannot let the lights go off. The folks cannot let the gas go where it needs to go, the coal where it needs to go, and so forth.
I remember the first time I heard somebody describe what you described, which is we may actually exercise this option even if it's against the price. I thought these people are insane. But the point being, your point is well taken there, which is the distinguishing factor. The question is whether there's something inside the contract that can end up getting hedged, literally hedged. That couldn't be hedged in that what you described can't be hedged in the financial market because you're making it a non-price driven decision. And I'm with you on that. All right?
Yeah, and I'm just saying that those components that we're all talking about are so wrapped up together, it's kind of hard to go back and unscramble the egg.
Well, let me also say,
can I ask a real quick question? So let's say we concede that there's a need for greater clarity, but maybe to Wally's point, maybe if this is a hypothetical, if the clarity has the effect of making more instruments trade options so that they have to be reported, and then let's also say that in the position limits rule, a trade option is not considered to be included in the spec limits because it's not something you're easily able to speculate in. And so the only other thing left then would be if the contract is a trade option, it has to be reported through the Form TO. Help me understand how big of a deal that is, and do folks think that just the obligation to report that alone would be enough for people just to decide, you know what, I don't want to do this anymore?
The way the CFTC's interpretations work right now is that...
I'm not asking about how it works now. I'm asking, so what I'm trying to get to the heart of is it, and this has been something that's been discussed, since the rule was proposed, is there seems to be some concern about the obligation to report a trade option. And I've always wondered, I'm trying to better understand why that's such a significant issue for the reporting entity.
Because of cost. Because if you don't report, you get pulled into Part 45, and you have to create systems to go and report. Many end users don't report today, or they rely on other end users or other swap dealers to do the reporting on their behalf.
You said if you don't report, then you have to report under 45?
If you don't report, if you don't send the $1 billion threshold email to, I believe it's DMO, you can be pulled into Part 45 reporting, as my read. I might
he's
be wrong
talking about
that.
sending the email, and he's talking about Form TO. He's talking about the simple alternative. So what if that, I think that's what you're asking, right? So what if that's all you have to do plus the basic business records you keep anyway?
You have to determine what gross notional is. You've all
And then
defined
maybe
it
that's
as...
a follow-up. Then maybe we give some further guidance on heat rate options if that's the one
That's
thing.
just an example. The whole concept of gross notional doesn't fit.
Didn't we give guidance, the FAQ that we cited in the for physical notional didn't cover enough transactions? Is that the problem, or the problem you're talking about now? Because we cited in the 13-08 to the prior guidance that we gave on physical notional for what we thought was this very reason, but maybe it didn't cover enough.
Physical
It did absolutely not. It did not cover close to enough, because the transactions, again, we're talking about today aren't swaps. They're not swaps. So back to Patty's point, I always try to use the KISS method. I learned it from somebody who was rather intelligent, who traded treasury bond options for many years. And we would have very complex portfolios. We'd always come back to the same thing. One thing, let's make money and use the KISS method. And that's what I would advocate here. With regard to cost...
I'm not familiar with the KISS method.
Keep it simple.
Did I miss that?
There is one more S, I won't say it. But in terms of cost here, is really, Commissioner Regent, is to the interest in people reporting. So the TO form is quite simple, straightforward. How to calculate it, I bet there's no common agreement whatsoever.
Because again, you have to figure out if it's a trade option to begin with.
Right.
And if what the CFTC, if what you're proposing is to,
I'm not proposing anything.
Okay,
I'm just,
if
I'm
what
trying
you're
to get a
speculating
sense
about.
of the burden of filing a report, if that isn't clear. I mean, and as you can tell, it's a little bit difficult to understand that would be a terribly burdensome thing to do, but I just want to make sure that's right or wrong. So
I think I can give you a very clear example. I think in the rules it estimated that filing the Form TO would take about 2 hours. Filling out the form, doing all that, that's pretty easy. Takes about 2 hours. I mean, for us, and we've got multiple regulated utilities, we realize that even trying to utilize processes we have in place for, say, Sarbanes-Oxley compliance or other contract review processes was not going to be enough. We went so far as to go hire a developer to develop a software system for us simply for the purpose of reviewing and analyzing our contracts to see how they evaluate according to all the different tests. So you do that, you include all the man hours it takes to go do that, you roll it up, and when you come up with what you think is a draft, you still have to sit down with all of your legal folks and do another review. So we think the cost, it's up there. And at the same time, these contracts that are falling out, at least in our case, it's not everybody else's case, but in our case, a lot of those contracts are also being reported actually in more detail through FERC or other required reporting aspects. So we feel like we're reporting the same information to do different agencies more than one time.
But let me say, if we ended up at the end of the day with no trade options and position limits and having to do Form TO, that would be, and we had clarity, that would be an improvement over where we are today. The issue that we see, and my clients see, is until Dodd-Frank, they didn't think that they had to know where the CFTC was or what it did. And they have no infrastructure, understanding, or real need to be involved in CFTC regulation. And many of them have made the decision that they're not going to report anything. They weren't doing futures, they're doing swaps, so they're only dealing with swap dealers. They don't have any of that. The more they get pulled into the CFTC universe, and maybe that's, by implication you're saying that's just a matter of life as we know it, they're going to have to deal with it. But their preference would be to manage their business in a way that does not include this type of thing. And fundamentally, you guys have further validated the existence of the forward contract exemption. And what we're saying is that we think if it's properly applied and you really analyze the nature of the contracts we're talking about, that they will fall into the forward contract exemption, and you respect that, and that's all good. Now, Wallace said that any contract that can be hedged with a derivative is somehow a swap or something, but fixed price forward contracts can be hedged with a derivative. I don't think that that's a test that's meaningful in this context. I believe it's true, but
no, I said an option, an embedded option.
okay, but what's the difference between that and a fixed price forward? At the end of the day, the question is, are these swaps or forwards? Can we have a test that would respect their true nature as forwards as we see it, and not just sort of default to trade options because it's for whatever reason we would do so?
Yeah, and I'm sincerely not trying to signal a direction here. I'm just trying to get a sense of the merits of the different possible options available to us in terms of policy decisions. That's all.
So, as David said, certainty that these contracts had to be reported on a Form TO is better than the current state, but it is still not free. The problem isn't filling out the form. The problem still is assembling the information that you need to fill out the form, which means tracking all of the contracts, because the process by which the deals are created, documented, stored, tracked is separate from the process that is used for financial derivatives. And the systems that store these were never designed to be able to flag these as this. So there is a burdensome process to aggregate the information. With all of the work that we have done on compliance systems and reporting and everything else, even though we're not a registered entity, we do in fact report on Part 45 and everything else for some of our counterparties. Given all of the work we've done, the marginal cost of Form TO for us is still on the order of a full-time equivalent. And my guess is that is a number that scales very, very badly as you go to smaller companies. because the smaller companies will not have done the investment that we've done in understanding the rules, building the systems, investing the people. So it would cost them more, not only relative to us, but more in absolute terms than it costs us. Now, that's a very different number from what the Commission had in its cost-benefit analysis. Is it a big enough number? There is also still the question, the statute says intended to be physically settled is out of scope. We have always argued that options that are intended to be physically settled are intended to be physically settled and therefore are out of scope as a matter of law. No shortage of lawyers in this room, so you don't need my legal opinion, but yeah, certainty
that was actually very, very helpful because if you factor all that in, then you have to start thinking about, again, when you're looking at a number of policy options here, what are the benefits to us in having the report in light of the burden? So that was helpful. Thanks.
And I think Jim's right. If you take it down to the scalable by entity, the 2,000 municipal entities across the United States, municipal utilities, all small entities, they all enter into commodity options of some sort or forward contracts with embedded optionality of some sort, variability of some sort. None of them have the systems to be able to report what they have always viewed as physical market transactions, cash market transactions, in a format that would be anywhere comparable to what the CFTC gets from its regulated entities.
And that's one of the factors behind the agree to disagree.
Since we're running well past our allotted time, let me just try to shift the discussion a little bit. As some of you pointed out, there's a range of actions that we, the staff, or the Commission can take to address these very complex interpretive issues. And so I want to focus a little bit more on what we at the staff or the Commission level can do in the immediate term in providing greater clarity, and what are some of the major areas that you would like to see us address in the form of a guidance, advisory, clarifying examples.
So I mentioned in my opening comments that we have some language that we think is helpful from the perspective of interpretive guidance. But again, my request is if you're going to give us interpretive guidance, it has to be something that we can actually rely upon. So I'm not a huge fan of further examples because further examples don't really give me anything I can rely upon. Interpretive guidance, such as the guidance that was used to, at least temporarily, fix the problem with the use contracts in the infamous however paragraph, that seems to have solved that problem, at least for now. Again, we've got some language. I alluded to it. David alluded to some. That would be a path forward that I think you could implement more quickly than getting to a new rule.
Well, and it's not a new rule. Again, the CFTC's interpretation, which is what was issued in August of 2012, can be changed by the CFTC. You can, I guess the staff could issue guidance as to what it meant in the interpretation in perhaps a quicker period of time, or they could open a rulemaking and have all of this discussion again. But I think you have the interpretation, you have the ability to issue interpretations or fix interpretations.
AGA did make a request for interpretive guidance February 22nd, 2013 with a set of very, very specific examples, which still remains pending. But what ultimately we would like to see is the Commission respond to the comments filed by an order, the comments that were filed on October 12th, 2012. We believe that is probably the most way to achieve certainty other than further guidance. And in terms of the OGC guidance on the storage and transportation agreements, we'd also like to see that rolled into a final rule and not sitting out there as guidance.
Yeah, it would seem to me that, in agreement with what the other folks had said, that something like the OGC clarification could occur in the short run, and then you could wrap that and the lease-like component into a further rulemaking sort of similar to what's happening with the de minimis no action letter being followed up by a rulemaking. So we can have an interim solution that deals with the pressing problem, but legally sound and more definitive way get the answer settled sort of for once and for all, with everybody having the notice and comment opportunity.
And most critically, I think you have people around this table and people elsewhere who are very interested in helping work on the language so that what happens is not that the CFTC comes out with additional interpretations that don't work for our industry.
Okay, then with that, we'll close this session. And as was mentioned earlier today, the comment, we are receiving comments up until April 17th, I believe. So each of you will have a chance to, as well as the public, will have a chance to follow up on all of the topics that we touched on at this session. Thank you all.
My name is Eric Remler. I am the Deputy Director in the Division of Registration, Division of Swap Dealer and Intermediary Oversight. I'm the Deputy Director for Registration and Compliance. I have with me here Israel Goodman, who is an attorney on my staff and who is working on this issue and has helped work on the proposed rule that the chairman announced earlier today. Before I get started, I've been asked to remind all of the participants on the panel that to use their microphones, they have to press the little red button to turn it on and then press it to turn it off, and to please speak directly into the microphone so that your comments can be recorded. I want to thank you all, the participants, for coming in today. I know some of you have actually come in from the West Coast, so appreciate your making the trip. We do see this as a very important topic. What you say here today will go a long way to helping the Commission and the staff in crafting a more appropriate, longer-term solution for the utility special entity de minimis issue. I'm going to briefly provide some background information on special entities and the swap dealer de minimis threshold, and then summarize the history behind the development of this issue here at the Commission. After that introduction, I'll ask the participants to introduce themselves and provide any remarks that they may have. Time permitting, we will then ask some questions for the panel and with the desire of generating some open discussion on the topic. So to begin, the Dodd-Frank Act for the first time required persons dealing in swaps to register with the Commission as swap dealers. The Act also provides additional protections for persons categorized as special entities when dealing with swap dealers. Specifically, Commodity Exchange Act Section 4SH imposes on swap dealers specific prohibitions on fraud and manipulation with respect to special entities, and subjects swap dealers to heightened business conduct standards when they advise or act as counterparties to special entities. The term special entity generally includes federal agencies, state and local governments, and their agencies and instrumentalities. The definition captures state and certain federally owned energy and natural gas operations. As the Commission has noted in adopting the rules, special entities that assume risk through the use of swaps also expose the citizen beneficiaries of their activities to the risks from the swaps. When a special entity suffers a loss from a swap, the special entity's beneficiaries, therefore, ultimately bear the burden of any losses that are incurred. Consistent with the congressional intent of creating the special entity category, in promulgating the swap dealer definitional rule, the Commission set a lower de minimis level of dealing activity with special entities for purposes of the de minimis exception to the swap dealer registration requirement. That level, as I'm sure all you know, it was set at 25 million of the gross notional amount of dealing activities with these entities. Any dealer who deals at that level or higher with special entities must register as a swap dealer. A de minimis exception, by its nature, will deprive counterparties of the protections provided by dealer registration and regulation. In implementing the de minimis exception, the Commission stated that it sought to balance the interests advanced by the exception against the risk that, if applied in an overbroad manner, the exception could undermine the regulatory protections, and specifically with respect to special entity counterparties, the special protections that such entities warrant as determined by Congress. Following the adoption of the swap dealer definition rule, a number of organizations representing government-owned electric and natural gas utilities submitted a petition requesting that the Commission amend the de minimis exception to exclude certain utility operation-related swaps entered into with utility special entities from the $25 million de minimis amount. Many of the petitioners are represented here today on the panel. In effect, the change requested would allow dealers to treat those swaps like swaps with non-special entities for purposes of determining whether they need to register. The petition stated that the amendment was necessary to increase the number of potential counterparties for these entities and preserve cost-effective access to customized, non-financial commodity swaps that utility special entities need to hedge and mitigate their commercial risks. Since some of the petitioners are represented here, I'll let you describe the reasons why this change is needed and hopefully provide some background as to why it's appropriate given the nature of your activities. In response to the petition and to subsequent requests for no action relief, the Division of Swap Dealer and Intermediary Oversight issued Staff Letter 1218 granting no action relief. The relief generally created an $800 million de minimis level for swap dealers entering into utility commodity swaps with the utility special entities. The letter also imposed a number of additional conditions for entities seeking to rely on the relief. Subsequent to issuing the letter, the Commission and staff heard from the petitioners and others that potential counterparties were still not making themselves available to transact with utility special entities. Among potential reasons provided was that the requirements imposed on counterparties in the staff letter were still deemed too burdensome for the relevant dealers to continue dealing. In response to these concerns, the division recently issued Staff Letter 1434, which supersedes and broadens the relief. The new letter, in effect, subjects utility operations-related swaps with utility special entities to the $8 billion general de minimis threshold and removed a number of conditions that were in the first staff letter. Letter 1434 provides that the relief granted will remain effective until any final Commission action is taken with respect to the petition that was received by the Commission. The purpose of this roundtable is to highlight the need to address the issues utility special entities are experiencing so that a longer-term and workable solution can be implemented. As Chairman Weegan announced, the Commission is considering a proposed rule amendment to address this issue, and the discussion we have here today will help inform the Commission and the staff in that effort. Before I turn to the panelists, I noticed that Commissioner O'Malley joined us. I don't know, Commissioner, if you want to make any remarks at this point, or?
Thank you. Well, I'm pleased to have this discussion. I'm pleased to have in circulation a rule change because that's the appropriate way to address this. The abuse no action process doesn't afford anybody the comment period or cost-benefit analysis. So I'm glad that we're taking the right steps to fix the rules where they need fixing, and I'm supportive of not distinguishing between special entity utilities and any other end user, and to put them on a level playing field to make sure that they're able to do their business in the same direct manner everybody else is, and not burden them with an additional set of rules that has thus far limited their counterparties to mainly swap dealers, and to free them up to the regional players that they had been dealing with on a regular basis to deal with their, regional utility concerns. I'm mindful that there's not a global or a national market for energy. It is a regional market, and trading around that is essential to meet, regional players in those markets. So, I haven't read the proposed rule that just landed on my desk today, so I look forward to reading that and turning around very quickly a document that is responsive to the concerns of the end users.
Thank you. I think that at this point we'll start with the panelists, starting on my left with Bill Rust.
Good afternoon. My name is William Rust, and I am the Compliance Director for the Energy Authority. I appreciate the opportunity to be a member of this Special Entity De Minimis Threshold panel this afternoon. Would also like to thank the CFTC and Acting Chairman Wiegand for the March 21st no action letter, as well as the proposed rule that was just announced today. We certainly would like to see the relief made permanent and do appreciate that. Headquartered in Jacksonville, Florida, the Energy Authority is a nonprofit corporation owned by 8 public power, electric, and natural gas utilities across the United States. We provide risk management service to our owners as well as contract customers. The Energy Authority provides front, back, and mid-office services to 40-plus public power clients, representing approximately 29,000 megawatts of electric generation, which includes clients as small as 50 megawatts of load, up to larger systems closer to 6,000 megawatts of load. Our business model at the Energy Authority allows us to provide the same level of service to both the smaller and the larger clients. Our clients serve both electric and natural gas end users, and the Energy Authority's primary corporate objective is to partner with public power to hedge risks by giving our clients access to wholesale power and natural gas markets across the United States. To manage risk, we transact both physical and financial products, primarily in electric power and natural gas, from next hour out through multiple years. We partner exclusively with public power clients and offer our clients access to a broad spectrum of counterparties, including banks, major oil companies, marketers, producers, RTOs, ISOs, investor-owned utilities, as well as other public power entities. Our clients use natural gas as a fuel to generate electricity and also sell fixed-price natural gas and electricity to end-use customers such as residential, retail, commercial, and industrial load. Our clients strive to provide reliable, low-cost energy to their customers, and the swaps used on the wholesale side help manage the inputs that ultimately determine the price paid by the household purchasing electricity or natural gas. Our clients are geographically dispersed across the United States, but yet all depend on liquid markets to implement the best possible risk management program. The nature of our business requires that we take different approaches depending on the region and the individual client. For example, our clients in the Pacific Northwest have found that bilateral electric power swaps meet their needs most effectively, while clients in the East can use natural gas futures combined with swaps to meet their hedging needs. We have found that liquidity for long-term transactions greater than 3 years is much higher in the bilateral swap market relative to the futures market. The $25 million de minimis threshold for swap transactions with special entities has negatively affected our clients' businesses. For example, our clients in the Pacific Northwest have lost over half of their bilateral swap counterparties. We have been able to continue to hedge, but remain concerned about the increased costs associated with the less liquid swap market. We appreciate the need to ensure that unsophisticated non-utility governmental entities should be protected from aggressive swap transactions. However, the Energy Authority was created for the purpose of helping out our clients and helping them manage their risks. Our business model depends on sound risk control practices that are implemented to protect our clients while affording them access to the best possible risk management program. Thank you.
Good afternoon. My name is Jim Tracy. I'm the CFO for SMUD. It's the Sacramento Municipal Utility District. We certainly appreciate the opportunity to be able to address this panel this afternoon. SMUD is a special district that serves most of Sacramento County. We have about 600,000 retail customers. SMUD is always ranked real near the top in the country in terms of customer satisfaction over the last several years in the J.D. Powers surveys. The one element of that has been our ability to set rates for 2 years and basically be able to tell our customers ahead of time, almost a year in advance, what the change is going to be. Many of our very large commercial accounts run businesses that require very large amounts of power. So example, Intel, Aerojet, air products type companies, internet servers, and light manufacturing. Having the ability to see what their price is going to be and having it fixed for 2 years is really important to their business models. So about 50% of SMUD's power is produced with our own gas-fired generation. And in order to achieve the rate cycle that we do, and we do this every 2 years, we set the rates, we really need to fix the price of gas for about a 3-year period. And so at today's prices, for us, that amounts to about $600 million of gas that we would be contracting for. When prices were up closer to $8, it would have been like $1.2 billion. Also important to know is that each $1 change in the price of gas for that 3-year period results in about $150 million change in our overall costs, which is about 4% of the retail rates. So trying to hedge this through exchanges poses 2 problems. The first, which will be discussed here and has been discussed, is that the products actively traded on an exchange are imperfect hedges. The price of gas in Louisiana doesn't change in lockstep with the gas in California. If you were out there during the energy crisis, you knew this in spades. But the second is the higher cost of collateral. And I want to explain how that figures into our business model. With our strong balance sheet and our ability to set fixed prices for the recovery of whatever we entered into on the swaps, so it's basically matching fixed retail prices with fixed wholesale cost of gas, we're able to negotiate contracts with our counterparties that allow for up to $15 million of credit for mark-to-market. We have had in the past like 16 active counterparties. And by spreading our exposure over the 16 different parties, we had almost $250 million of credit before collateral posting was required. Of course, exchanges require 100% posting. So over the last year, half of our counterparties have stopped trading with us. This has reduced our available credit by almost $120 million. I've stepped up, I've told our board that we're fast reaching the point where the cost of just maintaining additional collateral would become too expensive to maintain the level of hedging that we're doing. So whether we have actually posted collateral or not, we have to have the cash on the balance sheet, or we have to have letters of credit ready if the market prices change so that we can meet the collateral posting requirements. To put it in perspective, each $100 million of reserved cash right now is equal to about $4 million a year in cost. That's about $10 million overall, which it could end up costing us. So the alternative is to go to our board and talk to them about passing through the changing fuel prices to our customers using a fuel cost adjustment. This, of course, would have an impact on our local business in Sacramento County, not to mention the approximately 25% of residential customers who are on low-income discount rates. We, on a regular basis, report significant risks to our board, and we do this once a month. And I'll tell you that our board, just reported earlier this week, and our elected board was very appreciative of the no action letter recently granted. The ideal, of course, would be to have a permanent fix. And I have to say that SMUD, again, certainly appreciates the opportunity to provide some of the detail of how special entity rule has impacted our customers.
Good afternoon. My name is Virginia Schaefer, and I'm with the Bonneville Power Administration. I'm an attorney with the Office of General Counsel based out of Portland, Oregon. And I too want to add my thanks to the Commission staff and most especially to Chairman Regin for the most recent no action letter. And then I've not had a chance to review it, but the proposed rule that's come out this morning. And as others have mentioned, join in with the recommendation that we all have that we need some permanent solutions to the special entity de minimis threshold issue. So with regards to the adverse impact of the special entity de minimis issue, for Bonneville, there has not been quite a direct impact. Instead, what Bonneville has seen, though, is an overall drop in the number of counterparties, especially counterparties for longer-term physicals and swaps in general. So we've just seen an overall drop in the liquidity of the market. I'm not quite certain if that is necessarily tied to the concerns over the special entity issues and or just the overall regulatory burden that Dodd-Frank in some part is imposing on a lot of counterparties. So at this point, I'd like to take the opportunity to tell you more about what a diverse group the special entities are. Because Bonneville is a bit unique compared to some of our other special entities that are represented here today. We're one of 4 federal power marketing agencies within the Department of Energy. We're self-funded through our ratepayers, not taxpayer funded. And Bonneville markets wholesale electric power from 31 federal hydroelectric projects along the Columbia and Snake Rivers. We also market the electricity from 1 non-federal nuclear plant and from several other small non-federal sources. And while Bonneville does not actually own any of the generation, we do supply about 1/3 of the electric power used in the Pacific Northwest. Now, Bonneville also operates and maintains about 75% of the region's high voltage transmission system, and our geographical area of service covers Oregon, Washington, Idaho, western Montana, and small parts of Wyoming, Utah, Nevada, California, and eastern Montana. So we have a fairly large footprint. And as I noted earlier, Bonneville is self-funded. We recover our costs through our rates, and obviously it's in our best interest and our customers' best interest to keep our costs low, which includes working to mitigate our risks and in the most efficient way possible. And to give you an idea, one other item I wanted to pass on, but in terms of our overall operating revenues for fiscal 2013 was $3.35 billion. So we do have a rather sizable energy and transmission business. So Bonneville's statutory responsibilities are to meet the power needs of its preference customers, and those are the consumer-owned utilities in our region, and that includes the public utility districts, the people's utility districts, cooperatives, tribal utilities, municipalities, and other federal agencies. And again, as I said, within that large geographical area. Bonneville also sells power to investor-owned utilities and some direct service industries in the region. And when there is a surplus of power in the Northwest, then we sell to marketers and utilities in Canada as well as elsewhere in the Western United States. Now, Bonneville's challenge, of course, is that we're primarily a hydro-based system. It's 80% of our generation is hydro-sourced. And consequently, we're very much subject to a supply issue, as it were, of our fuel. And the timing of when that fuel is available is something that we can't control, unlike many others that utilize either coal or natural gas or other types of generation. In addition, there are many competing interests for the water. There's irrigation, transportation, flood control, recreation, conservation, such as ensuring that there's sufficient in-stream flows to permit the passage of fish up and down the river. And with rare exceptions, pursuant to the various federal statutory provisions, these competing interests take precedence over our ability to generate electricity. So all of those things mean that we have some real, a lot of balls to juggle in order to be able to make sure we have sufficient generation on hand to meet our load demands when it is needed. So, because springtime comes, we get a lot of snow melt and get a lot of water, but there isn't always a lot of demand. So, whereas come late summer, the snow melt is gone, it's hot, people have their air conditioning on, all of those things, we tend to then, of course, start having an increased demands for electricity, but have less fuel available. So consequently, we are always out there looking for ways to balance our system, well, primarily we have to balance it physically, but that can be done through lots of different tools, as others have mentioned already. And again, to also reiterate some of the other shortcomings of our system is that we have very little storage capacity. And so consequently, Bonneville has for decades made extensive use of short-term and long-term purchase and sales contracts by using, for generation, by using instruments such as forwards and futures and swaps and options to make sure that we can meet our customer demands. And we have successfully used these instruments to hedge and mitigate both our supply and price risks in an effort to keep our costs low, because again, we are a not-for-profit agency, and we also want to minimize the price volatility for our ratepayers. We have also participated and continue to participate in financial instruments, but as Jim was mentioning, like with SMUD, we do have the issue of being very costly in terms of posting margin. Most of our transactions, we are bilateral, and we generally don't need to post collateral in fact, I'm not aware of a situation where we do post collateral for our customers, our counterparties. And obviously that's not the case when we are dealing with going through cleared transactions where we do have to post margin, and it does impose a much greater burden in terms of monitoring our cash flow and ensuring that we can meet those margin calls as they come. So to wrap it up, I guess, is the Commission evaluates its rules and regulations for the utility special entities engaged in utility-related swaps for the operational hedging or risk mitigation purposes. What we're trying to make clear, I'm trying to make clear, is that all of us have been involved in this for years, and we have very significant core competencies in this area. This is not an area where there have been a history of any particular problems, unlike the issues surrounding other types of financial derivatives. Interest rate swaps, of course, are things that come to mind with regards to municipal entities in the past. So we respectfully request that utility special entities be allowed to compete on a level playing field with the other utilities that are out there, and let us do our business as usual, as we always have, and as we have done it well. So thank you.
Good afternoon. My name is Terry Nolte. I'm General Manager and CEO of Owensboro Municipal Utility. We're the largest municipal utility in Kentucky. Provide electric, water, and telecom services to the third largest city in the state. I'm going to provide a quick summary of how the special entity threshold has impacted OMU. First, want to thank the Commission and especially Chairman Weejan for the March 21st no action letter. We've already seen benefits from this policy change and applaud the Commission in its efforts to make permanent the change in the just announced rulemaking. My participation on this panel is an indication of the importance of this issue to smaller utilities, unlike my colleagues here who represent some of the larger public power entities in the country. We generate electric power with multiple coal-fired units, and we have significant surplus capacity that's hedged in forward markets to provide revenue certainty, offsetting fixed and variable costs associated with that surplus. This operational hedging activity insulates our ratepayers from wholesale power market price volatility and enables OMU to provide low and stable electric rates. A number of factors that affect our need and ability to hedge operational risks, but I'll focus my comments on two aspects: the physical nature of the electrical grid in the Midwest and Southeast, and secondly, how we've been impacted in our actual hedging transactions. The grid in the Midwest and Southeast was originally designed to allow individual utilities to move electric power from their generating stations to their customers. There was very limited interconnectivity between companies, but there's been significant investments made to improve that interconnectivity, especially for those companies that are located inside of a regional transmission operator market, such as PJM and MISO. OMU, like many public power entities in the Southeast and in the West, we're not part of an RTO. Geography, physics, and economics dictate that the only true interconnection between utilities are with our neighbors. Swap dealers provide limited liquidity for standard products at liquid trading points that are remote to the physical delivery points where we buy and sell wholesale power. Prior to the special entity threshold, these inexact hedges were not the only option available to OMU because regional utilities and their trading affiliates were willing to enter into swaps with OMU at points that were at or near our physical delivery points. Like us, these non-swap dealer counterparties are physical players in our markets. They share our need to hedge at points in the grid that are not the most liquid trading hubs, and thus recognize that standard products are not optimal hedging mechanisms. So prior to the March 21st letter ruling, these non-swap dealer counterparties have not been willing to enter into hedging transactions with OMU due to the risk that they'd be drawn into the swap dealer classification. This has had two significant effects. First, we lost about a third of our counterparties but the third of our counterparties represented 70% of our historical hedging activity. This resulted in a substantial loss of term liquidity that my colleagues have talked about. Traditionally, bilateral trades with regional utilities whose term positions offset OMUs, short versus long positions, created an incentive for entering into term transactions. These relationships were enhanced by our bilateral credit agreements. The move to swap dealers and exchanges as a result of the special entity threshold, coupled with the winter's polar vortex, has been extremely detrimental to OMU because those swap dealers have been focused on the near-term markets and managing the volatility in those near-term markets and have lost interest in the long-term markets. Second, OMU has incurred increased collateral and credit costs. Jim talked about this, but I'll give you another example. With the loss of trading counterparties, our two options for executing term hedging with swap dealers was with either swap dealers or on the exchanges. In reality, the swap dealers with which we had ISDAs in place widened their bid-ask spreads, knowing that our regional counterparties were no longer trading with us. As a result, executing the hedges on the exchange was a better option for OMU, but still at a significant incremental cost. We had to pay fees for execution, and for the first time, we had to provide cash margining. Previously, negotiated collateral agreements with counterparties permitted hedging without cash margining based upon the strengths of our respective balance sheets. Over the last 18 months, our margin requirements have ranged from $4 million to over $10 million, with less term hedging than what we believe is optimal. For utilities serving just 26,000 customers, it's a significant cost. Additionally, stress testing of the positions has resulted in additional reserve requirements to ensure that we have adequate cash liquidity to meet margin calls in high volatile markets. These are all extra costs that we have to pass through the ratepayers with no benefit relative to the pre-special entity rules. Finally, I want to assure the Commission that OMU and the public power industry have the expertise and the risk management systems in place to understand these markets, to properly evaluate the credit, price, and operational risks associated with our operational hedging activity. It's a core competency of all public power companies with market and commodity risk exposure. Despite the ups and downs of for-profit energy traders, not a single public power entity has defaulted since 1998. Likewise, operations-related swaps of public power utilities pose really no systemic risk. And I thank you for your attention.
Try to get it turned on. Good afternoon. Chairman Weejan, Commissioner O'Malley, and staff, thank you for the opportunity to participate today. My name is Randy Howard. I'm with Los Angeles Department of Water and Power, and I've been here a number of times on this topic, meeting with staff, and so I appreciate the willingness to continue meeting with us and working through these issues. Los Angeles Department of Water and Power is a department of the City of Los Angeles. We're the country's largest municipal utility. We serve about 4 million people. I'm going to try not to repeat some of the things you've heard here, but just go over some of the specific impacts related to Los Angeles. So our annual fuel and purchase power budget is approximately $1.5 billion per year. So as you can imagine, a $25 million de minimis level is a very small quantity for us as a utility. We have physical facilities in 7 western states feeding into the City of Los Angeles. Our customers are our owners. We don't have a group of shareholders that we can turn the risk and the burden to. So Mr. Tracy spoke about something they're contemplating at SMUD as to how they might move the risk onto the ratepayers. Due to this particular rule and the loss of some of our counterparties, the City of Los Angeles moved forward with taking the risk for some of our hedging and moving it onto the burden of our ratepayers. The governance went forward with a rate action, and quarterly we take all the risk related to the cost of our fuel, and we impose it in a rate onto our ratepayers. This has had a significant impact to them. Having that many customers, we have 300,000 low income and lifeline customers. We have many customers that are fixed income, and having those types of adjustments on their bills have a direct impact. They have no ability to to hedge themselves. And so we have had that impact related to this rule, and we appreciate right now the no action letter and then the proposed change in the rule, because that will have a very significant ability to go back and have the counterparties necessary to hedge. We all here have that obligation of keeping the lights on 24 hours a day, 365 days a year, regardless of the climate conditions. This winter was an extreme winter for Los Angeles, as it was for the East with the polar vortex. We're going through an unprecedented drought. That drought's impacting our hydro abilities. We don't have the reserve water behind the reservoirs and the dams to meet some of our needs. Therefore, we need to burn more fuel. This year, our fuels usage is up dramatically, as well as our emission profiles associated with that. And so there's a great uncertainty to our ratepayers as to some of the costs associated with that. The other issue that's hitting us more recently is the ground is shaking. We have earthquakes in Southern California, underneath our building in LA. We were able to hedge and have more options available to us previously that were some of our risk mitigation related to the potential of earthquakes and droughts. Many of those positions we have let go as a result of not having the appropriate counterparties. So we're hopeful to get the permanent rule change. We do appreciate the no action letter and think it will have a direct impact on our ability to transact again with our counterparties. And going forward, we would like to continue working with the staff and the commissioners associated with this activity. Thank you.
Thank you and good afternoon. I appreciate the opportunity to be here. My name is Patty Donville. I'm a partner at Reed Smith, and I have worked with the not-for-profit electric group since 2010 and written more than 45 substantive comment letters to the CFTC on various topics. I'm on this panel because I drafted the petition for rulemaking in 2012, asking the Commission to exclude from the $25 million sub-threshold a very narrow category of operations-related swaps that these entities across the United States, that are special entities, need to run their electric businesses. And it would also impact those who have special entity gas utilities as well. What the petition is not, it is not in any way to affect the $25 million sub-threshold as it would impact interest rate swaps. So a counterparty who is not yet registered as a swap dealer would still have to consider those interest rate swaps with a utility special entity in considering whether or not it exceeded the threshold. Another thing that the petition is not is an exclusion to allow the utility special entities to speculate, deal, or trade in those types of utility operations related swaps. It is specifically to allow them to do what they do, which is deliver power 24/7 at affordable rates. The best way to hedge that, and in that context we mean hedge or mitigate commercial risks. Those commercial risks exist. These are not risks that these utilities assume by entering into these swaps. The swaps that we're talking about are risk mitigating swaps, but to allow them to enter into those swaps as part of their core competency and to have access to non-registered swap dealers in these regional markets in order to continue to provide their electric service to their constituents. I'm happy to answer any questions about the petition. I look forward to reading the proposed rules, and I'm sure that we will be commenting. Thank you.
Good afternoon. I'm Lael Campbell, Director of Government and Regulatory Affairs for Exelon Corporation. Exelon is the nation's leading generator and supplier of electricity in the competitive power markets. Exelon's Constellation business provides physical energy products and services to approximately 100,000 business and public sector customers and more than 1 million residential customers. I'm here today on behalf of the Edison Electrical Institute. EEI is a trade organization for all the investor-owned utilities in the United States, and EEI's members serve over 70% of all electric customers in the U.S. EEI members are physical commodity markets participants that rely on swaps primarily to hedge and mitigate their commercial risk. At the outset today, Commissioner O'Malley spoke about turning the discussions today into action, and in this case, the Commission a week or so ago already took action, which we greatly appreciate. And it was great to hear Acting Chairman Weejan talk about taking the next step of formalizing some of this into a formal rule. EEI appreciates the issuance of the March 21st no action letter on the de minimis limit applicable to utility special entities, which recognizes the lower risk of swap transactions that occur between end users. Many EEI members have longstanding commercial relationships with municipalities, such as the ones at this table, power authorities, and other special entities as part of our core electric generation supply businesses. Although swap transactions with these special entities are not the most common form of transaction we'd engage in, the recent no action letter addresses some of the material concerns that prevented EEI members from engaging in those swap transactions over the course of the last few years. The March 24th no action letter is a great improvement and is appreciated, but there are some remaining concerns. Most notably, there remains some uncertainty as to whether a person meets the definition of a utility special entity. Without clarification from the Commission that a person can in good faith rely on a representation from the counterparty that they do indeed meet that definition, EEI members may believe that it is their burden to make that determination themselves, and more importantly, that the member bears the significant risk of getting that determination wrong. So hopefully the Commission could clarify to some extent that counterparties can rely on the representation from their counterparty that they do meet the definition of a special entity. That would alleviate a lot of the risk that we still feel remains to some extent. Finally, I would also like to discuss the concerns of EEI members and other end users with the general de minimis threshold and the current transition from $8 billion to $3 billion in 2017 that's going to occur absent Commission action. This sudden arbitrary drop impacts the ability of utilities to engage in long-term planning. Commodity prices are unstable and vary considerably over time, and the certainty of a stable, consistent de minimis threshold will assist EEI members in managing their risks. Also, given the variable nature of commodity prices, the Commission can't know or even meaningfully evaluate what the cost-benefit impact of such a dramatic reduction in the de minimis threshold will be 5 years from now. The current proposed drop in the de minimis threshold also will have an impact on the recent Commission no action letter from March 21st, as these swaps are now included in the $8 billion general de minimis threshold that is going to drop to $3 billion. Having the Commission provide additional certainty on this issue by clarifying that Commission action with the opportunity for comment will be taken prior to a reduction in the de minimis limit will provide additional helpful certainty to the market. Thanks again. I look forward to the discussion.
Thank you, Lael. Jerry, I noticed you came in a little late.
Yeah, sure. Jerry Jeske, Chief Compliance Counsel for Mercury Energy Trading. I'll make it brief. We come at this from a little bit different angle, and we are not a participant today because of the rule. And the cap that was put on, and as many folks have been speaking of here today, would take us out of the equation because we're an end user that has no interest in becoming a swap dealer. So I just want to say a heartfelt thank you to Commissioners Weejan, Commissioner O'Malley, and staff for issuing the March 24th no action 1434. I think it was well reasoned, and just really appreciate the attention to this matter. We can try to serve the greater public interest of creating liquidity for what is obviously an essential business across the United States. We can fill that void. We can be part of the process. But as I think Lau was mentioning, there is this looming $3 billion threshold, ratcheting down, so to speak, that everyone is going to have to take into consideration. So effectively, with that looming out there, folks will create, again, an arbitrary level, because we can't just focus on electricity. We also have to look at the gamut of energy, fuel oil, oil, natural gas, across the board. And if you're going to manage your business in a way that's going to be arbitrarily limited at some point in the future, you really have to put that cap in now, which will again reduce liquidity, unfortunately. And so we're hopeful that the Commission can not only address this, as Commissioner Regent said, in terms of formal rulemaking, but also pay attention to this potential ratcheting down. But thank you again, and we really appreciate the no action.
Are there any other technical, Lois, I'm glad you raised the issue you did about the reps. Is there anything else along those lines that we should anticipate comment letters pointing out in response to the proposal, assuming we can get it released?
The other issue we've explored is, well, there's a few things, right? We've spent a lot of time and energy putting in internal policies to prevent swap transactions with special entities, since it was, as part of our Dodd-Frank implementation, our biggest risk. So in order to use, for our company, in order to use no action level, we're going to have to actually change some of our internal policies. And also the reps themselves, I think the Commission should consider whether all the reps are necessary. It is going to involve changing agreements with counterparties to a certain extent. Right now, we were talking with the ICE folks earlier. ICE eConfirm is probably the most common platform used by energy market participants. Right now, the confirmation process is sort of automated for regular swaps. It's going to, again, force a potential change to that process. We can't rely on the current eConfirm process to get these reps in place. We're going to have to long form it, so to speak. Those are relatively small burdens. I wouldn't certainly don't outweigh the benefits that the relief provides. But the risk I noted about making sure that we can rely on a rep that the counterparty is a utility special entity, I think would be the most important one for us as we look to potentially engage in these transactions.
I would also add that the no action turning into a rule, I think, is a wonderful development. It does particularly focus on a couple asset classes. I think that might need to be expanded. Certainly, many generation relies on coal, fuel oil. And I think the focus on natural gas as an input is certainly helpful, but it may need to be expanded. If a utility is going to make a rep that they are receiving inputs to generate power, that should be pretty broad, I would hope, to meet. I think Randy was mentioning there's some you don't know when the water's going to be there or not, and you might have to burn other sources of fuel to be able to provide the power that's necessary. So I think that might need to weigh in as well.
Well, I think in the petition we did talk about energy and energy-related swaps, and we talked about essentially any fuel for generation. We also talked about emissions or environmental attributes swaps, as well as renewable energy credit swaps or other types of swaps that would be directly, again, related to the utility operations. Would not allow them to trade metals, to trade crude oil, Brent crude, or literally anything other than things intrinsically related to the operation of the utility. One other thing I wanted to talk briefly about, you asked if there were any other sort of embedded landmines in this. And not to beat a dead horse from this morning, but remember that it's utility operations related swaps. I represent counterparties that transact with utility special entities as well as utility special entities. And that discussion about what's a swap and what's a trade option or what's a forward with embedded optionality, all of which are, I think, non-swaps, plays into this as well. Because as Lael said, the hurdle, the $25 million sub-threshold was an issue because you don't want to go close to that unless you know darn well you want to be a swap dealer. You have a choice of the people that you transact with. You have a choice of the markets that you trade in. Utility special entities don't have that choice. They need these products to hedge or mitigate their commercial risks. And for that reason, to the extent that utility special entities can't enter into long-term forward contracts with embedded optionality, that raises any specter that that transaction is going to be treated as a swap, that too restricts their ability to hedge their risks.
During the panel, there was some mention of core competency in swaps, and as I mentioned in my opening remarks, special entities, Congress said to treat special entities a little bit differently. Here we're being asked to treat a particular category of special entities basically as non-special entities for particular types of swaps. So I was wondering if some of the representatives of utility special entities here, if you could speak to perhaps how long you've been using swaps, how frequently you use swaps, what you mean when you say it's a core competency.
Sir, Randy Howard, LADWP. We have been in business about 100 years right now, serving the city of Los Angeles. And I think, again, what's the definition of a swap? But I mean, from the optionality perspective, we've probably been utilizing various types of optionality from the very beginning. And again, early in LADWP's history, hydro was a big issue, but fuel oil and various motors and other things came along the way. And so you needed to hedge based on potential weather issues and potential outages of pieces of equipment, unplanned outages. You have major transmission lines that at any point could have a failure, and you need to have an option for an alternate source. And those need to be in place ahead of time. You don't wait till the event occurs. That's the same with planning for droughts and earthquakes. So I would say it's been a core competency from the very beginning to keep the reliability high. And we see that we have a skill set very capable of managing both that risk and the hedging operation that goes on.
I've personally been involved in the trading markets since FERC Order 888 came out in 1988 or 1998, and you know, we employ people in our power marketing group that are experienced traders, most of whom have worked in for-profit or for utility subsidiary trading companies. We've used swaps, fixed for float swaps, both just outright swaps at different points, trading hubs, since the markets offered them. So in MISO, that would have been, in the Midwest ISO, that would have been 2003. In PJM, it would have been before that. I can't remember the exact date. Maybe Lyle knows. But ever since they've been available, we've used them. They also use swaps for day-ahead versus real-time power as well in those RTO markets. So we've been doing it for a number of years.
in California, SMUD has really, I would say that one of the demarcations was when we went to deregulation. That's where when SMUD established energy risk management as a sort of a corporate goal. And I mean, we went through the whole energy crisis. We did not have a big issue with our power supply cost. And it's basically because we were able to do hedging while the private utilities were not able to do hedging. And it's very well developed in our company. We have an executive group that basically provides the boundaries within which our buyers have to stay. And it's basically, these are matching retail load with our wholesale obligations. So I think the term trader is a misnomer for us anyway. The 95% of what our folks do is actually just matching up the portfolio of resources with our retail load. The only trading, so to speak, that they really do is probably on a daily or weekly basis when we actually have power plants that aren't fully utilized, and we sell that into the market, or we buy some buy some economy energy.
So for the energy, so for the Energy Authority, we do represent quite a varied set of clients who have been in the business for many years. Our corporation itself was started in 1997 as a result of FERC Order 888889. I have been in the power marketing business since that time, almost 18 years. And the Energy Authority was created to manage those risks for our clients. We started off with three original clients, three original owners. They developed our organization to build those competencies. We have a comprehensive risk management policy. We identify risks. We control risks, and we limit risks with that policy. And it's certainly something that is the focus of our organization.
And I guess I was just going to follow up again with what I mentioned when I spoke earlier. Our system being hydro-based and the fuel being something that we don't have as much control over as other types of fuel sources for other utilities. It's been inherent in our business from the get-go, from 1937, that there would have been, usually what we had done in the past certainly were just either long-term purchase or sale arrangements just to ensure that we had sufficient generation available to us when we might not expect to have sufficient water and or generation. And just going back, I have a copy, for example, of the FY 2013 financial report and the annual report, and we have a whole section that deals with our risk management and derivative instruments. We have a transacting risk management committee that helps, again, sets the sideboards on what kinds of things folks can do. Again, we're very careful, especially given the nature of kind of entity that we are, that definitely there's no speculative trading. Period. It's always meant to serve our needs. Traders are not supposed to go out and trade because they think the price is good. There are more specific criteria that is involved. And again, like I said, even just in our annual reports talking about the risk management and the how we model the different types of risk using the Monte Carlo simulations and so on, looking at our credit risk with regards to our other customers. And we have also used interest rate swaps in the past, those kinds of things, just to whole variety, but again, you know, we go out there, we make sure we either have the people who have that capability, and or we seek the advice to make sure that we have protected ourselves in the best way that we can.
I'd like to ask a question about the nature of the counterparties that are affected by the rule or have been affected. You know, Terry, you mentioned that you lost about a third of your regional counterparties. In this area, we have the financial entity, swap dealers. We also have entities such as Exelon and Mercuria. Are there other types of entities that you have been trading with who are counterparties, and not just Terry or any of the other members of the panelists, just sort of to help fill out our understanding of who the counterparties are that were affected?
Specifically, you know, all the counterparties that we were enabled with that came to us after the sub-threshold was set and said they would no longer take our name are utility-affiliated trading companies, without exception. And we're a little unique in that most of my colleagues here are you know, talking about balancing their supply portfolio with their demand by their customers. We're a seller generally. And so if Exelon wanted to buy power from us, they couldn't because we're a special entity. And we've traditionally been a supplier to companies like Exelon, for example.
So in effect, are you saying that you yourselves are to some degree doing dealing and you are affected by this rule? Is that?
Well, obviously we have to have counterparties to trade with. So by being classified as a special entity, that kind of tainted us from our ability to be able to monetize the value of the excess, the surplus capacity and energy that we had.
I would add to that, because we deal a lot with the natural gas to fuel our power plants, that some of the oil, gas, physical folks are the ones that have dropped trading with us. So
I can, because I represent a variety of different counterparties to special entities, I can give you general categories of types of entities. Regional gas producers who would ordinarily transact with the utility special entities in their region. They have shut that down. A natural gas utility located in the central northern United States. They do not transact with utility special entities. The retail group, Mid-Atlantic, who used to have customers who were electric retail municipalities, they no longer enter into anything that smacks of volumetric optionality with utility special entities. So a whole variety of counterparties in different regions of the country have excluded that counterparty class because of the $25 million threshold.
I just wanted to add one thing, and basically our remaining counterparties are financial firms. And one of the, you know, as the enterprise risk person at SMUD, I always have to think of all the bad things that could happen. And one of the things that would concern me is, you know, there's some talk of limiting the ability of banks and investment banks from owning physical assets like power plants and pipelines and such. And obviously, if that came to pass under, you know, what the rule was, we would think that a lot of the financial companies would drop out of that sector of trading at that point.
So for the Energy Authority, the clients that we have lost have included utilities, marketers, producers, as well as we lost some oil and gas companies in the beginning.
For Los Angeles Department of Water and Power, some of our counterparties that we lost were more natural gas producers. We own a number of firm pipeline rights. So we also own a gas field ourselves in Wyoming. So there are other parties, smaller players, regional players, that determined that the risks were too high. We also have had a number of EEI type of utility counterparties that have determined that it's probably just easier not to conduct or transact directly with us.
I just wanted to follow up on something you mentioned, Terry. You said that you're already seeing an effect in the market due to the recent no action letter. What have people expressed to you in terms of what's changed when you compare the previous no action letter 1218 to the current no action letter? What do you think has caused that change? And if anyone else has any other thoughts?
I think clearly the answer is the no action letter that was issued. Since its issuance, we've already done a swap with one of the counterparties that had previously not traded with us. So we have seen at least one of our counterparties come back to us. And that was, again, because of the regional nature of our market, it was a transaction that made sense for them and for us as well. And we were effectively excluded from that as a result of the previous subthreshold issue.
Can I say that different counterparties were concerned about different ones of the conditions that were included in the prior no action letter? Some were very concerned about the requirement to take a firm position as to whether or not you were a financial entity. That definition, as most people know, is not clear. And the intrusion of that definition from another part of the CFTC's rulemaking, where it's already been questioned, created an ambiguity in the no action letter. Similarly, there was, it had to be, the transaction had to hedge the physical risk of the utility swap entity, of the utility special entity. The hedging physical assets test is in the swap dealer rule. Most of the utility special entities, not being swap dealers, haven't come to grips with that rule. They could have represented that they were hedging or mitigating commercial risk 50-50 or 50-50 because they've read that, they understand that. So that was another ambiguity in the middle of that no action letter. Probably the most, the one I heard the most from counterparties who were just saying it's easier not to deal with it, is the requirement to report yourself to the CFTC, that you had gone over the 25 million during a particular quarter, that you were comfortable that you were not a financial entity, that you were comfortable that the utility special entity was hedging their physical risk, that you were comfortable you met all of the conditions, because if you didn't, or you made the wrong determination, you were subject to audit and potentially having inadvertently tripped yourself into registration as a swap dealer.
So just to clarify, the issue that group of people was having was specifically essentially notifying the CFTC that they were relying on the relief, or was it the fact that they had to make a representation to that effect?
No, it's essentially saying I relied on the no action letter, which means you had better be sure that you're comfortable that you have relied on the no action letter, and I went over the 25 million with this special entity on this date with this trade. If you made any of those determinations wrong, and you had reported yourself to the CFTC as having been rock solid certain, then you may have, in 2020 regulatory hindsight, have been required to register as a swap dealer. Most of the counterparties that I spoke to were not ever intending to become a registered swap dealer. They paid attention to making sure that they had characterized everything absolutely correctly. And for one of these transactions, you could go over 25 million with one swap, or certainly with one long-term forward contract with a special entity with any type of questionable volumetric optionality.
Do you think that that issue would be somewhat addressed if we were to address the issue that Lael raised regarding reliance on representations?
The issue that Lael raised, which is still a requirement in the March 21st no action letter, can easily be fixed, it seems, in the rules. The swap dealer rules in many parts indicate that the counterparty can rely on a representation of their counterparty, and I guess I would encourage you to have that type of a requirement there. But bringing back the variety of other conditions that were in the March or in the 12/18 no action letter, I think would again re-engage the problems that this group experienced with that no action letter.
Let me ask, with regard to the, I think what I'm hearing you saying with regard to the representation is, I think that the letter says that representation can be made, but it doesn't say anything about the counterparty relying on the representation. Is that?
No, it says something about a representation can be made in another place, that they are hedging or mitigating commercial risk. It says it there. It does not say it in the line where it says the counterparty is a utility special entity. So if you are amending Rule 1.3 GGG4, that same provision that would allow the counterparty to rely on a representation of the utility special entity is what Lael is requesting.
As I'm sure you know, Patty, a lot of the other rules that talk about relying on a representation say you can rely on a representation unless, of course, you have knowledge that that's not a problem.
Not a problem.
Okay. Good. Getting back to the notice issue, there was one question that came to my mind. One of our concerns is that if we create this special category in a rule, the utility special entities are still special entities with regard to interest rate swaps and other types of swaps that are not in your core competency. And as such, if there are dealers trading in those areas, or in any area, frankly, with you, it may be difficult for us to distinguish which swaps that are being reported to us through the swap data repositories and so forth should be counted by the dealers when determining whether they need to register or not. So one thought was to have entities that are going to rely on this kind of relief simply notify us that they are relying on the relief, not necessarily get to any specific conditions, which I understood was a big concern for them. I want to ask the panelists, do you think that's a reasonable request, a one-time notification?
If the LEI are on a swap and the LEI for one entity is a utility special entity and the LEI for the other entity is not, then that data, it would seem, would already be in the swap data repository. Yes?
But it's possible the swap could be something other than the type of swap.
They're always going
that's
to be in
included.
the other commodity asset category, right? They're always going to be a product, a unique product identifier that would identify them as energy related.
I suppose it would depend on how specific the unique product identifier is. Yeah, that may be another way to go about it. Okay. I think that's all we have, and I think we're right about at the time. I don't know if anyone else has any other statements they want to make, or if not, at this point, I think we'll close the panel. Thank you very much for your attendance. Appreciate your coming here.
I want to thank you again, just your willingness to hear from the utilities and continue this effort on working with us. We appreciate it. Thank you.
Thank you.